there's a systematic upward bias in equity markets.
The market is trying to look through the valley here.
If it's a 1 month shock, the market has to price in the risk that it might be 2 months.
There's just been absolute violence in terms of the rotation.
Be watchful rather than making massive structural changes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, no end in sight.
The International Energy Agency agreed to coordinate the release of a record 400 million barrels of oil, which will substantially reduce the oil prices as we end this threat to America and this threat to the world.
Crude rallying despite officials announcing a major release of energy reserves. The tension deepening, leaving tankers coming under fire across the Middle East, and banks telling their Dubai staff to stay away from the office until further notice. Brent briefly breaking triple digits once again.
The big question was, why are officials releasing so many barrels of oil unless they see something that we don't see? Why are they doing the biggest release in history? The why is right here. The International Energy Agency came out this morning and said the war in the Middle East is creating the largest supply disruption in the history of the global oil market, saying it is hitting 7.5% of global oil supply. You have that kind of hit, try pricing that in, it just means oil price is higher.
The headlines keep coming. 2 oil tankers coming under fire. The numbers keep climbing. Huge fire at a facility in Oman. The pressure building in places like Asia. China once again tightening fuel export curbs. It's headline after headline.
And Secretary Wright said last night on Fox News that basically this is just to tide the world over until you have the conflict basically ending. But guess what? This is not enough oil per day. Jeff Curry yesterday talked about the flow to tide us over. If the Strait of Hormuz right now and the flows going through that are 90% down, and it's not even just the fact that it's such a big bazooka of oil, individuals are concerned about how long this will last. It's the fact that you're seeing this. You're seeing tankers on fires, and the market is starting to say this is going to be potentially very prolonged.
Which market? Crude? Equities right now pretty calm. Equity futures negative by 1/3 of 1%. Equities and equity investors are looking through the pain at spot, looking out further out along the futures curve. But you're starting to see a rally there at the back end as well, particularly around the end of this year. New forecast from Goldman. Take a listen to this. Fourth quarter Brent average, $76 a barrel. If it's a 30-day disruption, if it extends to 60, you're talking about a $93 a barrel average price in the fourth quarter. That is a major change to the outlook.
And there's an exponential shift higher in terms of pricing expectations the longer this goes on. Bloomberg Economics putting out a forecast with 1 month, $105 a barrel. With 3 months, they're talking $163 a barrel. So to your point, to Goldman's point, the longer this goes on, it's not necessarily just a linear change. It is a step change, and it really potentially could impact the economy.
Brent crude this morning, 96.30, WTI around 91. Coming up this hour, we'll catch up with Keith Lerner of Truist with markets focused on the Middle East, Matt Gertken of BCA Research as President Trump vows to finish the job at Iran, and Jorge León of Rystad Energy on how crude could top 130. We begin this hour with our top story. Fresh attacks on tankers in the Persian Gulf sending crude higher and prompting massive evacuations across the region. Bloomberg's Jumana Basenji joins us now from Dubai for more. Jumana, it's day 13, and as you look at the region at the moment, it's difficult, I imagine, to say things are getting better because it looks like things are getting worse.
That's indeed the situation. And President Trump saying yesterday that the strait is in good shape. And actually, the reality on the ground paints a very different picture. Just in the last 12 hours, we've seen multiple developments at key energy infrastructure sites in and around, by the way, not just the straits, but around the broader region to Persian Gulf. 2 vessels off the coast of Iraq, and that is the most northern part of the Persian Gulf, were targeted. They were set ablaze and were on fire in the early hours of this morning, causing disruption on export terminals over there. And then if you go all the way to the bottom of the Arabian Peninsula, the Salalah port in Oman, that's a fuel depot, also targeted as well. And then throughout the course of the evening, another export terminal on the Gulf of Oman, one of the biggest actually around the Gulf of Oman, and a key export terminal for Oman, which exports 1 million barrels a day. They were also targeted, which led to the evacuation of vessels from the area. Now, they have said that they have resumed operations in the last few hours, but still just underscores that not only is the Strait and the transit through the Strait becoming an issue, but more broadly, the entire region, the Persian Gulf, the Gulf of Oman are also increasingly targeted. Bahrain also got targeted once again, their fuel depot over there. They have halted operations. And then overnight, this has been happening for several days now. It isn't getting as much attention because the projectiles have been intercepted, but multiple attempts of the Shaiba oil field in Saudi Arabia being targeted as well. Saudi Arabia alone intercepted 43 projectiles overnight. So for all intents and purposes, the conflict seems to be expanding. No sign whatsoever that things are letting up. And if anything, Iran keep going after key logistics and energy infrastructure hubs in the region.
Jumana, let's finish up by talking about Dubai. You moved to Dubai, like many other people. Dubai has done so much to attract international talent. To see the headlines cross recently from Goldman, Citi, Standard Chartered, telling their staff to stay away from the office. How much has changed where you are in just a few weeks?
Well, I'm broadcasting from home today as well. And out of an abundance of caution, what you're hearing from financial institutions, including the ones that you just mentioned, is that they are advising their employees and personnel to stay away from the office, to work from home, continue working from home for the foreseeable future. Many institutions have also allowed for temporary relocation of staff, again, out of an abundance of caution. Now, this isn't a formal evacuation notice, I should say, out of the DIFC, but the intensity of strikes over the UAE has picked up once again. I should mention that the interception rate has been extremely high, north of something like 93, 94% for all of the incoming ballistic missiles. But anecdotally, in the past 16 hours, we have all, as residents of this country, received incoming missile alerts. And just in the past 6 hours, we've heard of debris causing a significant amount of damage or some damage in some residential areas. And so on the back of that, I think many institutions around here are erring on the side of caution. That is not to say there's been a formal evacuation notice, but the feeling is very much one of wait and see how this all evolves. But for the time being, again, there are no signs that things are beginning to let up. So better to be safe.
Jumana, stay safe and stay close. We'll catch up with you in the next hour or so. The tension in the region, compare and contrast that with the calm in the equity market. Equity futures right now in the S&P down by about 1/3%. Here's the view on Wall Street this morning. Keith Lerner of Truist writing the following: the bull market still deserves the benefit of the doubt, though we expect choppy, range-bound trading to persist given the geopolitical backdrop. Keith joins us now for more. Keith, welcome to the programme. Let's just get to that calm in this equity market compared to the tension elsewhere. What's anchoring the bullish view?
Yeah, well, first, good morning to you all. It's one of those years, Jonathan, that I'm glad I didn't have the headlines ahead of time writing the outlook, because as you mentioned, we've had this kind of ongoing, what I call the carousel of concerns. As one concern recedes, another one comes up, and obviously Iran is front and center. I think to your question, like why is the market somewhat stable, is, think about the last 5 years, everything the market has gone through, whether it's, COVID, supply chain disruptions, the fastest rate increase by the Fed since the 80s, the highest inflation since the 70s. And despite all that, the market is still close to all-time highs. And I think the North Star of this bull market has been earnings. Earnings at this point are still trending higher. And I think, to my overall point, I think investors are giving this bull market the benefit of the doubt, because we've seen so many corrections, and the wrong thing to do historically during these big events at the time was ultimately to sell. So I think that's why the market is being somewhat calm. I'd actually like to see a little bit more panic to set up a better buying opportunity relative to where we are right now.
Steve Hoth, the Federated Hermes, yesterday came on and said that when oil prices get on average above $90 a barrel, that would change his constructive view because it would start to do damage to the underlying economy. Do you have a thesis like that, where suddenly you start to get more concerned about the cycle of the economy right now?
Yeah, I don't know that there's an exact number per se, but we do follow a weight of the evidence approach. Part of that is on the economy. So if our economic group in general starts to shave back our forecast, that would be a concern. We look at relative prices, we look at the credit markets, and I think those earning trends and the earnings momentum in general are all things that we're watching closely to say, hey, should we be adjusting our overall position? Right now, we still are maintaining a modest overweight to equities, but we also wrote a note earlier this week, suggesting that this is not the time. We haven't had enough of a correction relative to the risk to say this is some type of buying opportunity. And what's also notable is look at the indexes relative, as Jonathan alluded to, like the ACWI or global equities are still up about 1%. The S&P's down 1%. The US dollar's up 1%. So if you didn't have the headlines, you would think this is kind of a normal kind of uneventful year.
Right now, I'm just struck by the fact that people have been conditioned to buy the dip, and they've been conditioned year after year after year, partly because there is a policy response that can be delivered, right? 2020, we got what we got from the Fed as well as the bazooka from the federal government. 2022, there was a sense that also there was going to be some response and there was more momentum in the economy. Is there that same policy lever this time around?
Yeah, it's an open question. A lot of debate right now is, it looks like the administration may be looking for an off-ramp, but it may not be fully up to them because obviously the Iranians have a lot to do with this as well. But I do think big picture that, there is a focus from the administration. And then also China, there's a lot of China's imports go through the strait as well. So it may not just be U.S., it may be China as well. So I think ultimately there is likely some type of off-ramp. And that doesn't mean that some of the volatility and the tensions go away. But listen, the administration is focused. We all know it's the midterm elections. I do think there's going to be some things they can do, but obviously it's different than the terrorists where they can basically just step away themselves. There's other partners that they have to rely on.
But, Keith, how do you parse through what the administration is saying? Yesterday, the president told Axios there's practically nothing left to target in Iran. And then last night at his speech, he said we don't want to leave early, right? So the president is opening the door for a prolonged conflict to before they would decide that it is mission complete.
Yeah, well, the one thing I would be thinking about, obviously, as you look at even consumer confidence surveys over time, and inflation expectations, they correlate very highly with gas prices. So I just think, again, no one knows exactly how long, what the pain threshold is, but ultimately, high gas prices isn't going to be helpful going into a midterm election. So I think that's going to be front and center. And the open question that no one can really say is, does that mean the threshold is, 2 weeks, 2 months? It's hard to say. But I think ultimately, just like there was a focus last year about, hey, if the 10-year Treasury starts going above 450, 475, there's really a more increased focus and even more headlines that are dropping from the administration. I think we'll likely would see that as well. Again, if oil stayed elevated at these levels and we started to continue to see some of the polling data deteriorate.
Keith, help me understand this one. We've had a major move in crude, up by more than 30% so far this month alone, and a repricing further out the curve as well. And yet, Keith, energy equities are up by a little more than 1%. Energy stocks on the S&P 500 have barely moved off the back of this story. What gives?
Yeah, well, for one thing, the energy stocks had a big rise going into this. So I think that's one thing. I think overall, the energy market is still relatively constructive. And there's also, some of the cost structure within the energy complex will also go high. So there's some offsets. I think ultimately, though, the energy sector on pullbacks is actually relatively attractive after not doing anything for several years. But again, heading into this whole, this whole tension, we saw the energy sector being among the top sectors for the year. And same with gold. Gold went into this being up about 40%, year to date. So I think that's just kind of the reason why we haven't seen more of these moves in both energy and gold prices per se.
Keith, always good to catch up. Thank you, sir. Keith Lerner there of Truist on the equity market. This equity market is just not buying the story coming out of the Middle East. Not buying it at all.
Markets have been conditioned to ignore geopolitics, to look through it, because ultimately they have been burned every time they tried to lean in. This is a market that has been conditioned to take any kind of histrionic concern and view it just as that, histrionic concern. At the same time that you do have people in other markets right now treating this as very real, and those are the physical markets and the oil markets in particular. Trying to pair those two is getting increasingly an exercise in cognitive dissonance, and we see it every day.
Brent crude, 96.50 this morning, up by around 5% on WTI, higher as well, up to 91.30. Up next on the program, finishing the job in Iran.
The International Energy Agency agreed to coordinate the release of a record 400 million barrels of oil. Oil prices are already coming back down, and it's going to come down, but we're not leaving until that job is finished, and it's going to be very fast.
Those prices aren't coming down this morning. Up next, we'll catch up with Matt Gertken of BCA Research, live from New York City this morning. Good morning. Back into triple digits overnight. The high of the session, 101.59, up by more than 10% briefly. Here's the state of things right now. Brent crude higher by 5%, 96.80. WTI around 91.70, also higher by about 5 percentage points. In the equity market, seemingly ignoring most of it. Equity futures down by about 0.4%. Where there is some pain, if any, it's small caps. The Russell, negative 0.9.
It's a double whammy there. On one hand, you've got benchmark rates that are going up in anticipation of a Fed and central banks globally either remaining on hold or even hiking rates. Meanwhile, you also have this idea of a downward trajectory for growth, given the fact that consumers are going to have a huge hit to their budgets as a result of rising gas prices.
And the Federal Reserve's not stepping in anytime soon. Two-year bond yields at the highs of the year, 365 on twos, on tens, about 422. Under surveillance this morning, finishing the job in Iran.
The International Energy Agency agreed to coordinate the release of a record 400 million barrels of oil, which will substantially reduce the oil prices as we end this threat to America and this threat to the world. We don't want to leave early, do we? We got to finish the job, right? Oil prices are already coming back down, and it's going to come down, but we're not leaving until that job is finished, and it's going to be very fast.
So here's the latest this morning. The White House vowed to release millions of barrels from the Strategic Petroleum Reserve to ease surging energy costs. Crude still pushing higher following attacks on tankers across the Persian Gulf. Bloomberg's Tyler Kendall joins us now for the latest from Washington. Good morning, Tyler.
Hey, John, good morning. Well, this move perhaps underscores that continued disruptions in the Strait of Hormuz show no signs of abating, as the Trump administration is now set to tap the Strategic Petroleum Reserve for 172 million barrels. The U.S. Energy Secretary Christopher Wright saying that it will take about 4 months to fully deliver those supplies. And the U.S. is now vowing to replenish the SPR with about 200 million barrels by the end of this year. But the move does mark a reversal for the Trump administration, which reportedly told G7 allies on a call earlier this week that it would oppose any intervention in oil markets amid concerns that it could be premature, according to the Wall Street Journal. That tracks with what has been some mixed signals from the administration regarding its policies when it comes to the war with Iran. In those remarks yesterday, President Trump had indicated again that we could see the war end early, in his words, as he maintains that the U.S. is ahead of schedule in achieving its objectives. But then he went on to say that he is willing to sustain the military conflict for as long as it takes. As you heard, the president did mention how this is part of this coordinated release with the International Energy Agency, which, as you mentioned on the program earlier, reported in a new report this morning that we are expected to see global oil supply slashed by about 8 million barrels per day this month. John, against that backdrop, we know the Trump administration is mulling a few different options to help curb prices at the pump for retail consumers here in the U.S. And that includes new reporting by Bloomberg News that President Trump is considering invoking the Defense Production Act and emergency power to spur offshore oil production off the coast of California in a bid to boost domestic supplies.
Tyler Kendall with the latest in Washington. Tyler, thank you. We already produce here in the United States something between 13 to 14 million barrels of crude a day. How much more can you get out of production here?
The issue is the Strait of Hormuz. And the Wall Street Journal this morning has reporting that the U.S. has turned down repeated asks from oil companies for the Navy to escort them through the Strait of Hormuz, according to the Wall Street Journal, citing Gulf officials. So that is what needs to be reopened in order for prices to be depressed, not some potential new drilling that won't come online for years.
Brent crude, 96.36. Matt Gertken, the chief geopolitical strategist at BCA, writing the following. The US and Iran are now too deeply involved in conflict to avoid significant negative economic ramifications. Matt joins us now for more. Matt, welcome to the program. I understand Iran has offered some conditions to end this. How far apart are these two sides?
Thanks very much. Pleasure to be with you. Look, I think the key thing is that Iran chose war over dismantling their nuclear program forever. They've had multiple rounds of negotiations. What they saw was domestic unrest and that they could save the regime by facing a conflict or enduring a conflict with the U.S. and Israel. And so they've made this choice, and that shows that they're ready to escalate beyond the pain point that Donald Trump was hoping to wind down the war at.
Matt, do you think the Iranians really understand that the threshold for this president is $100 crude?
Yeah, of course they do. I think it's easy to see that President Obama in the wake of GFC, had over $100 per barrel oil, and it was one of the reasons it was a malaise sort of in the country, and he faced troubles in midterm elections. President Biden, of course, was sort of ruined by high energy prices as well as inflation. So I think it's well known that the pain point for the American population is quite low, and they can see the polls. I mean, the problem is this war is starting with a very low level of popular approval, and over time, popular approval tends to wane.
At the same time, we have heard from President Pezeshkian in the most specific matters yet in terms of what would it need to take to bring the Iranians to the table. Do you think this is real, or do you think this is just diplomatic fodder for public consumption?
Well, I do think it's real in the sense that ultimately the Iranians do need to come to the table, because if the U.S. resorts to indiscriminate bombing and, just overwhelming military force, then the U.S. can probably destroy the regime. It's hard to destroy a regime from the air, but if there ever a case in which it could be accomplished, this is probably one of them. So Iran doesn't have an incentive to push that far. They don't want the U.S. to destroy all their ports, all their facilities, assassinate all their next rung of leaders, wipe out critical infrastructure. That would render them, non-existent. And so they basically have to twist the knife and force everyone to realize that President Trump is capitulating, but then they need to back off before the Americans resort to really overwhelming tactics.
Matt, you said that right now it seems like Iran and the U.S. are too intertwined and too involved in this conflict to avoid, as you said, significant economic damage or significant negative economic ramifications. From your perspective, when you talk to clients, when you talk to investors, do they seem to be acknowledging that, understanding that, starting to price that in?
Yeah, I think there's been a big transition in terms of how people are thinking about the conflict. I mean, for a long while, those of us who are geopolitical strategists sort of focusing on the issue, maybe were seen as alarmist. Now it's recognized that there is a significant economic cost. But of course, we are seeing the release of oil reserves, and that can create some space here. I mean, if you look at what the IEA is doing, you probably have a month, if you released all the reserves and you did it urgently, you have a month where the U.S. Armed Forces can try to clear the passage in the Strait. So that does buy time. So I think it's just an issue now of vigilance. Basically, investors know that this could create a massive shock. It could create an economic recession in the worst case. But they're not going to leap to that conclusion until they see that there's extensive damage to the physical oil production infrastructure in the region.
Matt, do you think that people are going to try to avoid the Strait of Hormuz going forward just because of the specter of danger that will still lurk over the region?
Yeah, I think that conclusion is warranted. I think anyone seeing this understands now and in the future, even in the best case scenarios we have today, everyone will still recognize that these geographic choke points are still relevant. But for that very reason, renewable energy and alternative supply lines are going to become very important. So for the U.S. and its allies and for free countries around the world, that can mean investing and opening up new production in places like the Americas or in Africa. But for China in particular, it will mean building pipelines and production in Central Asia and Siberia, working with Russia because they need to find a way to avoid interdiction by American military and naval forces.
Hey, Matt, good to catch up. Thanks for being here. Matt Gertken there of BCA Research. It always depends on what hat you wear. If you're an equity strategist right now, I imagine you find some of this alarmist. For the guys who are tracking the story on the ground, though, this is just an accurate depiction of what is taking place right now.
Yeah, people are looking elsewhere. I am struck by the fact that who's benefiting the most? Russia. Guess who's exporting that much more oil and benefiting on the cost side? That nation, which is currently in a war with Ukraine.
Up next on the programme, Jorge León of Rystad Energy as crude nears triple digits plus. We'll get you some morning movers this morning. We'll check out Morgan Stanley in the pre-market. From New York City, you're watching Bloomberg TV. Two-day losing streak on the S&P, looking to avoid day three in the hands of what happens here. To an extent, Brent, WTI. Brent crude this morning higher by 5%, 96.64. Jeff Currie of Carlyle put it well just yesterday. Policy options are unlikely to break crude's ascent, while Hormuz remains blocked. And blocked it remains. That's the picture for oil. Here's the picture for the equity market. The S&P, the Nasdaq, the Russell shaping up as follows. Futures, negative 0.4 on the S&P. On the Nasdaq, we're down by 0.3. On the Russell, we're negative by 0.9. Are we starting to rethink the outlook? Now you're starting to see bigger and bigger moves further out the crude curve.
So far, analysts who we've spoken to have seemed to split up on different sides of this. On one hand, they're saying the cyclical rotation can still remain in place based on where the pricing was and based on the fact that consumers are still getting that tax return that could potentially bolster them. And then you have other people saying, hold on a second. You start looking at discretionary income, you start looking at how much it gets eaten away by higher gas prices and higher prices in general. This is starting to look like a less robust economy.
Barclays out with a note talking about how if the oil price spike is persistent, which at this moment it looks like potentially this is going to be at minimum a few more weeks, the higher the downside risk to earnings and valuations. What does it mean? We have another supply shock and it hits GDP. There's going to be negative effects, and maybe at some point the equity market will start waking up to that.
Let's talk about some single names. It's not just about energy. That's where the headlines are. But there's an ongoing story. And the tension keeps building in private markets. I want to talk about Morgan Stanley. Check it out in the pre-market. Not just this name, but others as well. So the latest headline, they're capping redemptions. This is about private credit funds. We've seen those headlines from Cliffwater, limiting redemptions. JPMorgan, you saw that just yesterday. Restricted lending to private credit funds, marking down the value of certain loans. The tension, Lisa, keeps building. Now, over the last 10 years or so, every now and again, you see a fund, this happens, and you hear about the word gating. This is happening almost all at once and everywhere.
The redemption requests that the likes of Cliffwater and Morgan Stanley have been getting, a Morgan Stanley fund, I should say, are significantly bigger than what they're willing to allow or leave the fund. Morgan Stanley said, well, the structure of the company was intentionally designed to balance the desire to offer investors the opportunity for periodic liquidity with the less liquid characteristics of the portfolio. That said, there is a feeling that maybe some of these loans are not marked according to where they could actually trade in markets, which is the reason why Apollo is saying we're going to create public marks and we're going to show you what they are. But that is the fear right now. What are some of these companies not disclosing and trying to cover up by not necessarily liquidating the underlying assets?
So how comfortable can you be in this moment in financial markets? The energy story leading to a reappraisal of the future path for monetary policy in places like the Federal Reserve, less easing, places like the ECB, maybe an interest rate hike. But at the same time, capital markets are still open. We heard that from Kevin Foley of JPMorgan talking to us earlier this week. Deals are getting done. His words. We just had the biggest one-day IG supply on record earlier this week. You've got spreads both on investment grade and high yield still pretty tight, and an equity market very, very close to all-time highs. Can you take comfort from that, given what's happening elsewhere?
If we hadn't been talking about what's going on in the Middle East, this would be the front page story every single day, all day, because it's really underpinning this question of how long can capital markets continue to support a really ebullient market. Right now, it seems like investors are willing to invest. If there is real deterioration in some of these loans, if you do see a lack of willingness to finance some of these projects on the part of private credit, how much does that curtail the enthusiasm coming particularly from the tech sector?
Futures this morning negative by just 0.4% on the S&P 500. On our radar this morning, one of our top stories, Morgan Stanley capping withdrawals from its multi-billion-dollar private credit fund. The bank limiting redemptions at its North Haven private income fund to 5% of shares. Elsewhere, Iraq shutting down its oil terminals after tankers were hit off the nation's coast. A port in Oman also suspending operations following an Iranian drone attack. And finally, the United States joining a record release of global oil reserves.
The releases, certainly out of the U.S. Strategic Petroleum Reserve, they'll go over about 4 months. But this conflict, I don't think, goes that long. I think we will have the Straits of Hormuz open well before then. Hopefully in the next few weeks, we will see ship traffic returning.
The White House pledging to add 172 million barrels of oil to market, with average gasoline prices hitting $3.60 per gallon.
And that price, that average price has increased more than 20% in the past less than 2 weeks. So it gives you a sense of the urgency of why. Is this going to materially suppress price increases in the short term? As Jeff Curry said, it's about the flow of oil on a daily basis. And the maximum, at least in the Euro region, is about 2 million barrels a day versus the 10 million barrels a day that they actually need. So in the U.S., it might mitigate long-term price fluctuations. In the short term, it might not cap things so much.
120 days, that's far out, especially for this administration that wants to keep gasoline prices depressed. When you look at where they are nationally, 3.6 per gallon of oil. In the president's beloved state of Florida, it's actually 3.7. They're going to keep going up. They are closer to 4 than closer to 3, and that is a huge problem. And it all comes down to the Strait of Hormuz. Secretary Wright talking about at some point the Navy will be able to do this, even though he did tweet and then deleted the tweet that they couldn't. The Wall Street Journal says the U.S. is turning down repeated requests for tanker escorts from oil companies, according to Gulf countries. So right now, it doesn't look like they have the capacity to escort tankers, even if they wanted to.
Which is why Brent's still in the 90s. Brent crude right now 96. Brent briefly topping 100 after more tankers were attacked in the Persian Gulf. The IEA saying the war is causing the biggest ever disruption to the market as it gears up for its largest emergency release ever. Jorge León of Rystad Energy writing the key variable is the duration of the war. If it lasts 2 months, prices could peak at 115. If it goes on for 4 months, they could reach 135. Jorge joins us now for more. Jorge, we almost hit 120 on Sunday evening. Are all bets off now?
I think so. I think it really depends on the duration. And as Lisa correctly mentioned, the idea of escorting vessels, I think right now we don't see any progress there. So at the end of the day, this really comes down to maths. The Strait of Hormuz, around 10 million barrels per day that we think are going to be closed because of the situation. SPRs, 400 million barrels. That is not going to upset any upside price pressure that we are seeing right now. And interestingly, when the announcement of the 400 million barrels where it was done, prices barely reacted because I think that the market already assumed that something was going to happen. But last time that we saw SPRs being released was in March 2022 in the middle of the Russia-Ukraine war. And back then, when the announcement was made, prices fell by $5 per barrel. Right now, they didn't. And this really shows how important, how critical the situation is at the moment.
Oh, hey, we've seen production being cut. You've seen certain shut-ins taking place in certain places. Restarting from there isn't necessarily painless. And I wonder from your perspective what kind of damage we're already doing to supply chains.
That's the key. Supply chain. I mean, you've really hit the supply chain. And more importantly, from the geology point of view, the moment that you shut in production, you are changing the pressure of the reservoir. And that could potentially damage your reservoir forever. So we think that coming back to normal production, steady state production is not a matter of days. It's essentially a matter of weeks, if not months. So yes, the Strait of Hormuz could be reopened tomorrow. It will take a few weeks to clear up all the logistical backlog. But then you also have the problem of ramping up production again. And some countries, especially Iraq, might have severe problems doing that.
In response to higher oil prices, you've seen a lot of flights that have been either canceled or prices of the tickets go up substantially. You've seen mandates to use either carpooling or bike to work in certain places, particularly in Southeast Asia. How much demand destruction have you already started to see emerge?
Excellent point. I think that demand destruction is one of the important levers that how the market is going to react. We've seen during March, at the start of the conflict, around 1.4 million barrels per day of demand destruction. That is quite significant, 1.4 million barrels per day. Initially aviation, and now gradually that impact is going to be translated into transport fuels and heating oil. And if the conflict lasts for longer, then we are probably going to see a refueling of inflation, which could change the attitude of central banks around the world. To give you a data point, before the war, we thought that oil demand was going to grow by 1 million barrels per day. If the war extends for around 4 months, let's say, oil demand growth is cut down to just 400,000 barrels per day. So that's really showing you how important the demand destruction could be in the coming days and weeks.
One of the other levers, Jorge, is more production from other areas that aren't as affected, like Russia. Do you have a sense of how much more Russia is earning as a result of higher energy prices and the fact that it's actually increasing production to help meet the needs of its allies like China?
Sure. We've seen the waivers that India received to continue importing Russian crude. Before the sanctions, Russia was exporting around 1.6 million barrels per day to India. Then last numbers before the war was around 800,000 barrels per day, so quite a significant decrease. And with the waivers, we think that there's a little bit of an upside potential, around 1.2 million barrels per day. But importantly, there is a lot of Russian oil right now in offshore storage. So the fact that India is going to be able to increase its purchases of Russian crude does not directly mean that Russia could start pumping up more. I think what it means is that the offshore storage will be gradually cleared up. And going forward, we think that the upside potential for Russia is actually quite limited, no more than 200, 300,000 barrels per day. Apart from that, you don't really have much reaction in the very short term. Yes, shale can react, but that is something towards the end of the year. And again, very limited. I don't think more than 300,000 barrels per day.
There was a report even just this morning about Indian oil purchases from Russia increased by nearly 45% in March. So basically, does Russia just get back their entire export capacity that they had in India before the United States started putting pressure on New Delhi?
Probably yes. Now, the big question there is what happens when the war ends. Will those waivers expire? At the moment, those waivers are supposed to expire at the end of April. Now, when the war ends, will those sanctions be put back into place or not? And my hunch here is that once you lift the waivers, once you lift the sanctions, it is pretty difficult to go back and implementing them again.
I remember when the Red Sea was shut basically for months, and tankers and cargo ships didn't want to go through it because of what was going on with the Houthis. Even if the United States, Jorge, is able to reopen the Strait of Hormuz, when will it go back to quote unquote normal?
That's the key variable here. I don't think that, first of all, the scenario of the U.S. escorting vessels, we don't see appetite from shipping companies to take that option at all right now. The mechanism is still not in place, and we don't think that this is likely to happen anytime soon. So to me, the only way forward for the Strait of Hormuz to be reopened is through two channels: regime change, which at the moment doesn't seem very feasible, and the other one is through a ceasefire.
Jorge, it's good to see you. Thank you, sir. Jorge León there of Rystad Energy.
Thanks.
It doesn't look like we're close to either right now, and the criticism is starting to come from international leaders. And I think I go back to that Chancellor Friedrich Merz note from earlier this week, that there doesn't appear to be an exit plan. There is some comfort, I think, on this side of things in the US and capital markets that there will be an exit. There is a fear elsewhere, particularly from those that are exposed to this story, more exposed to the energy story, that there is no exit plan.
And it seems like right now, even within the U.S., you're hearing some rumblings of the same. A real question, if Iran is viewing this as an existential risk and they're trying to attack ships in the Strait of Hormuz to show, don't mess with us because this is what we're going to do. We're going to shut down supplies of 20% of your oil and a significant part of your fertilizer. They're going to keep going no matter who it hits. That doesn't seem to be something easily counterable or really reopenable unless you add some serious force.
And when you hear from the president, you hear almost both sides. He said yesterday practically there's nothing left to target in Iran, which makes you think potentially this is going to unwind pretty soon. And then last night he said we don't want to leave early, right? Basically saying we want to finish the job. Well, what does that finishing the job look like? Is it regime change? We're going to be there a lot longer.
WTI 91, Brent crude this morning 96. We'll keep tracking those prices for you. Up next on the programme, fueling inflation fears.
When oil prices go up, headline inflation goes up, that gets much bigger. The damage is going to take months to unwind. There is no policy response that can stop this ascent in crude. None.
That was Jeff Curry. We'll have more on that in just a moment. Plus, we'll catch up with Veronica Clark of Citi from New York City this morning. Good morning. You're watching Bloomberg TV. Brent on the month up by 30 to 35% and still down by something like $23 on the week from the high. Just gives you an idea of this wild ride over the month so far, and particularly the last few days on Brent crude. Brent crude 96.20 and up by 4.6% on the session. WTI just north of 90, pushing 91, up by more than 4% also. How many times have you heard this take? This was Deepak Puri of Deutsche Bank yesterday. Any major price increase would be tackled by the administration through a combination of measures. Comfort. This from Chris Harvey of CIBC. Stable credit spreads, decent EPS growth implies the current slump will be a viable pullback. Once again, comfort. And you see that in the equity market so far this morning, down by just 0.4% on the S&P 500. On the Nasdaq, down by a third. People feel somewhat comfortable with this situation?
Part of the reason why is because of the policy response. They expect either withdrawal from the region and end the war, some sort of pivot from President Trump, or maybe some sort of win that they can then announce and then end this. It seems less likely that it's that clean, and I think a lot of people keep talking about this. People also expect some policy response from the Fed. Well, what kind of policy response can they actually give if ultimately it is an inflationary shock, maybe stagflationary shock, but in the short term, definitely increasing prices?
I imagine central bankers aren't feeling comfortable right now. Two-year bond yields close to the highest levels since September of last year. The two-year this morning, 3.65. Under surveillance this morning, fueling inflation fears.
When oil prices go up, headline inflation goes up, that gets much bigger. A damage is going to take months to unwind. There is no policy response that can stop this ascent in crude. None. Get long, buckle your seatbelt, hang on for the ride, and we're going to reprice this thing.
Wonderful work from Jeff Curry of Carlisle yesterday. Direct, blunt. Here's the latest this morning. Surging crude costs adding to inflation concerns for the global economy. Average gasoline prices in the US hitting their highest level since May of 24. Veronica Clark of Citi writing inflation risks so far are mostly for headline, but the longer it lasts, there could be more pass-through to core. Veronica joins us now for more. Veronica, good morning.
Good morning.
You slated 3 cuts, 75 basis points, I believe, an April start.
Yeah.
Have you changed your view on things?
No, not yet. Obviously, risk that those cuts could start later, but we are still expecting 75 basis points. We'll obviously have to see how the latest developments unfold. But there has been a pretty clear pattern the last couple years in the labor market data where it's really spring and summer we start to see that weakening. And of course, we've already had some weaker labor market data recently. But in recent years, that means the Fed is cutting by the fall.
So what do you say about this move that we're seeing? How do you characterize this energy shock right now? Does it fuel inflation? Does it hit growth? Or is it something you can ignore?
It's both. Yeah, it is, raising those stagflation, scenarios back to the table again. I mean, for now, there's the first order effect is certainly on headline inflation. It is, we're not even halfway through March yet. We'll see what gas prices do for the whole month. But yeah, we're probably looking at something like a 50 basis point boost to March headline CPI. That's big. But that's from gas prices. And then, the longer it lasts, of course, the risks for core get more. Look for things like airfares to potentially rise, core goods prices. But those higher gas prices, I mean, that does mean consumers have less to spend on other things. That is a growth shock.
I hear the point about long term. It could be disinflationary. It could reduce spending power in other categories. That said, from a perception standpoint, inflation's already above target. Core PCE is expected to actually be a little bit uncomfortably hot that we get later tomorrow. Goldman Sachs cutting their forecast in terms of how much the Fed can cut, saying it just isn't plausible given this backdrop. Why do you think it is?
Yeah, so I think it is a supply shock, right? And the last supply shock we had were reminiscent of the pandemic. But this is a very different macro backdrop than we had in the pandemic. I'm very encouraged still by what I see in slowing wage growth. That's what you get with a loosening labor market. Yesterday's CPI data, shelter inflation is slowing a lot. That should continue. Should be abnormally weak even maybe this year. So this is not the demand backdrop that supports more persistent inflation. What you would want to watch for is if inflation expectations start to rise, then of course that gets more concerning. And that's why for now the Fed is going to be cautious. They're not doing anything now, but we'll see how we get to the summer.
Citi's house view has been different from the rest of Wall Street. You have thought that this was a weaker economy than a lot of people imagined, that the labor market actually was experiencing cracks that people weren't imagining. Based on this shock, which is a shock and is going to cause increased oil prices, is there a greater chance of even rolling over into recession? I mean, does it change the parameters of what could happen based on the starting point of this type of weakness?
Yeah, it feels really uncomfortable that this has been a very gradually weakening labor market for a couple years while we've had very strong growth and while we've had easing financial conditions. That seems to be changing now. And so I would worry that, business, transportation, energy costs and everything are going up. You've already been looking to cut labor costs for a couple years. What if that gets you to that final stage of some larger layoffs? Or at least, not hiring. And it does feel a little bit like we're a frog in a pot of boiling water where the unemployment rate every year does still rise something like 3 to 4 tenths. And at some point, it's not so low anymore.
You mentioned airlines and the cost potentially for ticket prices. Willie Walsh, who runs the International Air Transportation Association, this morning said you're looking at probably an 8 or 9% increase. He said it's inevitable. We already see that with a lot of Asia carriers as well because of where jet fuel is. Don't you think that is going to be incredibly difficult for inflation going forward?
Yeah, that airline component is the first one that you would watch, airfares of core inflation. It's really maybe like a 1 to 3 month lag. It happens pretty quickly where we start to see those rising. That is in our forecast a bit. But I think the big question for broader inflation is, the consumer has been weakening somewhat. Spending power will be coming down just as job growth is slowing. How much are you able to pass on these higher costs to final price?
But don't we see it potentially a knock-on effect like we are farm to table kind of economy that we saw during the pandemic, when then the Fed said inflation was transitory and ended up not being transitory?
Yeah. This is just a very different labor market, though, than we had then. We had a very tight labor market. We had unemployment benefits that were keeping people out of the labor force. You had very strong wage growth. Short-term expectations probably mattered a lot more than where you were seeing prices rise. You would ask for a higher wage. You would get that higher wage because there was no one else to hire. That is a very different transmission mechanism this time.
We're just tracking this cascade through international supply chains, and this headline just crossed the Bloomberg that India is asking China for a form of fertilizer, urea, as the war-induced gas crunch hits plants. You're just seeing it more and more. It's not just the oil story. It's the product story, particularly in places like Asia.
An even bigger proportion of urea goes through the Strait of Hormuz. And the reason why this is so concerning is it is the season when you have to be planting. And this is the reason why you've seen actually agricultural spot commodity prices increase by the most going back to 2023. People are starting to sniff this out. This could be a bigger concern. This is what we eat every day. And that's the reason why people are looking beyond just the oil shock.
And look at potentially diesel prices. That's what the entire construction, manufacturing, factory orders, that's what they all run on, even in the United States. There could be knock-on effects of this that aren't just hitting crude barrels.
And this is the point that Jeff is making, Jeff Curry of Carlyle, of course, that even if you lead to a period of de-escalation here, let's say there is an off-ramp. Don't know where it comes from or when it comes, but let's say there is one. After that, what are the lessons you've learned? Do you just move on, back to normal? Jeff Curry doesn't think so. It leads to a period of hoarding. The Chinese right now are curbing exports. Everyone starts to buckle down and prioritise their own electorate. Not China, there are no elections, but their own people. That's always going to be the priority. So where India asks China, of course, there's some kind of geopolitical relationship there they might explore, don't know. But in the future, you start to see hoarding. That's the bull case that Jeff is suggesting here.
Frankly, we saw that in 2020 after the pandemic. We saw people rejigger their supply chain lines, talk about keeping greater inventories. It became a hanging cost. At the same time, people thought it was worthwhile for insurance. To the extent that people were getting a little bit complacent, this just really highlights how they can't do that.
Veronica, when does this become too hard to ignore?
Yeah, I mean, we're only a week and a half into it or so.
13 days.
Yeah, 14 days, 2 weeks. Yeah, I think after a whole month, you're definitely getting more worried.
Veronica, thank you. Appreciate it. Veronica Clark there of Citi. The headlines keep coming, and right now Wall Street comfortable still, to a degree, to look through the shock.
There's been a shift in the past couple of days where maybe an off-ramp isn't as easy as President Trump saying, I want this war over, victory accomplished. Right now, it seems like there is a shift looking at whether Iran is willing to play ball and what it'll take to reopen the Strait of Hormuz.
Stocks this morning down by 0.5% on the S&P 500. In the next hour, we'll catch up with Jean Boivin of BlackRock, Libby Cantrill of Pimco, Stephen Major of Tradition, Sonal Desai of Franklin Templeton Fixed Income from New York City. Good morning to you all. The second hour of Bloomberg Surveillance up next.
You're going to feel that pressure of higher oil prices. So there's no escaping that.
If oil stays up for 2 or 3 months, it bleeds into a broader inflation.
I think both on goods and energy, we have a problem.
The headwinds for the consumer are building.
Get long, buckle your seatbelt, hang on for the ride, and we're going to reprice this thing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Let's start with crude. Brent and WTI. Brent briefly, triple digits once again overnight. This morning, 96.42, up by 4.8%. WTI up by 4.5, a 91 handle. on WTI crude in the equity market. Push it through stocks. A slight pullback on the S&P 500, down by 0.5 on the Russell. It's where the pain is, if you can call it that. We're down by 1% on the Russell so far this morning.
Yeah, a lot of people in risk assets are trying to wrap their heads around how long this could possibly take, not getting any answers. We're in a sort of void of any real information about the trajectory of this conflict. The here and now, though, is scary and potentially a real dampening factor to growth and a boosting factor to inflation. It's a toxic mix of stagflation that nobody wants to see. Some asset classes are taking that seriously, others not so much.
We've talked about this a few times. In equities, there is comfort that this will be over and you can look through it. On the ground, the facts are still very concerning. Goldman, Citi, Standard Chartered telling their Dubai staff to work from home. And we've seen energy and energy infrastructure take a hit across the region. Tankers, a few of them, catching fire.
Absolutely. And when you hear from Jeff Curry, he's saying there is no policy response that can stop this ascent we are seeing in crude oil and crude prices. And then it comes down to other things like you were mentioning, fertilizer, diesel, the product of crude. All of this is moving higher. And at some point, if this is persistent, it is going to hit growth. And that's what the equity market's going to have to grapple with.
We talk about the boiling frog. Turning up the heat, just slowly, every single day, private markets. I just want to go back to the headlines. Morgan Stanley capping redemptions, Cliffwater limiting redemptions, JPMorgan, this is all this week, restricting lending to private credit funds, marking down the value of certain loans. It's hit after hit after hit, and it just slowly turns the heat up every day.
And there are two issues here. On one hand, it's a question of liquidity, selling some of these illiquid loans to retail investors through different vehicles, and a question of what happens when they want to leave and whether that causes prices to go down. That's something people can handle, and you see some of the big investment managers saying, all right, we can take advantage of this and actually consolidate some of this market share. On the other hand, if you have that in addition to a geopolitical shock that pressures the economy, is there real credit risk that starts to build, especially if a lot of investors feel burned and pull back some of their balance sheets? That's kind of the question that people are grappling with at this moment.
The shock is coming at precisely the wrong time. Equity futures right now in the S&P negative by 0.5%. Coming up this hour, we'll catch up with Jean Boivin of BlackRock as crude climbs, Libby Cantrill of Pimco as Iran tightens its grip on Hormuz, and Steve Major of Tradition as the spectre of stagflation hoards global bond markets. We begin this hour with crude prices rallying as the war in the Middle East widens. Bloomberg's Jemana Basechi joins us now for more. Jemana, welcome back to the programme. We talked briefly about the tension in the region so far this morning. The Iranians did put out a list of conditions to end this thing. What's the distance between the sides at the moment?
Well, they did put a list out of conditions out. That was, you're referring to a post put up by the Iranian President Pezeshkian, which, by the way, appears to not have a lot of influence over overall decision making. We saw a similar situation over the course of the weekend when he sort of apologized to Gulf states for targeting them, saying that if they did harbor U.S. assets, then they would be subject to attacks. But later on, he was contradicted and almost pushed aside by more hardliner members of the Revolutionary Guard, who went on to say that they have no plans to negotiate whatsoever with the United States. They're not planning on looking for a ceasefire at any point soon. And I think from the Iranian perspective now, it's very clear that they are intent on inflicting as much economic cost as possible with these key targets on energy, on infrastructure hubs, on logistics hubs, on airports. The attacks are not diminishing. They're actually increasing with intensity and with specific targets in mind. And one thing that I would say also is there's a lot of daylight between what the U.S. are asking the Iranians for and what the Iranians have put on the table overnight. They say that they will only come back to the negotiating table if the U.S. give them reassurances that they won't attack again. Under what situation would the U.S. underwrite that possibility? It's not going to happen. President Trump also saying that he wants to see unconditional surrender. So still a massive amount of distance between the two sides. And you could say that, the events of the last couple of days, irrespective of, the policy adjustments that the Trump administration has introduced, the IEA announcement hasn't made such an impact on the market, because at the end of the day, the strait is still effectively shut, and it is dangerous for vessels to pass through not just the strait, but the Persian Gulf and around the Gulf of Oman and even the bottom of the Arabian Peninsula now.
Jemana, out of an abundance of caution, you're broadcasting from home today. Our colleagues are working from home in Dubai. Citi, Goldman, Standard Chartered telling their staff, ultimately to stay away from the office. Jemana, how long before Gulf nations need to make a difficult decision about whether to step in and fight this too?
Look, that is a calculus that I think many people have been asking, but at the same time, the hope out of Gulf nations is that this somehow does de-escalate. They want to bring down the temperature. They are intercepting a huge number of projectiles that have been fired towards them. You just think about the UAE alone. We're getting up to 2,000 projectiles being fired just towards the UAE since the beginning of the war. That surpasses the number of projectiles that Iran sent over to Israel in the 12-day war, right? And this is not technically an enemy, quote unquote, of Iran. But what has happened is overnight, we started to see bits of debris hitting residential buildings, some areas that are very close to the financial district. And there is concern, obviously, that the interception of some of these drones could sustain some more civilian infrastructure damage. And on the back of that, many institutions, including banks, Goldman Sachs, HSBC, Citi, we've been reporting on them this morning, have advised their employees to stay home out of an abundance of caution. This is not a formal evacuation order from the DIFC. Bloomberg ourselves, you can see I'm not in the office today. We equally are staying back out of an abundance of caution. But the hope from the Gulf states is that this does die down. They have maintained their right to self-defense. But equally, they have said that the primary objective here is to find a diplomatic solution out of it. No signals that they want to get involved militarily.
Jemana, we know this is an immensely stressful moment for our colleagues in the region, so thanks for making some time for us this morning. Jemana Basechi there out of Dubai this morning. That's the path we don't want to go down at all. That's the road to escalation.
The issue is that Dubai and other areas, other cities in the region have built a whole economy on being a sort of safe bastion, on being the cross-section between the East and the West when it comes to finances. How much does this potentially undermine that? At what point does this have to go on for people to say, wait a second, maybe it's not worth the level of expansion that we had planned?
97 on Brent this morning. Here's the view on Wall Street. Jean Boivin of BlackRock writing, the energy-led supply chain shock is likely to be short-lived. We see disruptions measured in weeks rather than in months. Jean joins us now for more. Jean, it's good to see you.
Good to see you.
Can you ignore this?
No, cannot ignore it. But I think we need to, two things need to be tracked, right? We need to see the disruptions that they continue to evolve, and the Strait of Hormuz is the thing to watch. How many flows of tankers and so on we see going through? We're about 16% in our analysis of the normal level. So this is clearly a massive shock for now. But at the same time, we think we need to think about the response, right? I mean, oil prices, the conflict is driving oil prices, but oil prices will be driving the response as well. And that part, I think, needs to be kept on the radar as well. I don't think the world can sustain months of $100+ and people will react to that. So I think that's why, I mean, we think this is not days for sure. But it's not months either. I mean, maybe a couple of months, but it's not months. So I think this is more of we're in a realm of weeks to...
Just hold on a second. You said maybe a couple of months. Goldman is out saying that if this goes on for 60 days, they're forecasting crude in the 90s for the fourth quarter. That's not spot right now. They're talking about where December is currently trading. And December is currently trading where? 70s, 80s over the last week or so? Yeah. 90 in the fourth quarter. Doesn't that change the story at all?
Well, the market has already been, assuming we're going to get like the kind of 90s plus number until, into June, right? So, and then declining to December. That's already a couple of months, and that's the world I'm describing here. So if we go with what the curve is pricing, I think it's a shock. It's going to add to an inflation narrative, or it's going to challenge the benign inflation narrative that's been prevalent before. So I think that is a big story there. But at the same time, it's not the stagflationary shock that would be a risk, and that would be more like if we're in months of 100+, then it's shaving 0.5% on growth, and it's an additional 1 percentage point on inflation globally in this environment. So that would be a significant risk.
When you talk about policy response, usually people are talking not just about fiscal, not just about political, but also about the monetary policy response. And right now, the market is pricing out the chance of the Federal Reserve in particular cutting rates. And they're talking about the ECB hiking rates. I'm just wondering how that changes your expectation, why you still think this is long-term inflationary, even if policymakers are going to tighten the screws on global growth.
I think it's long-term inflationary because for us, like even before the conflict, where I've been talking about here on occasion about this, we think that there's a structural inflation story in this environment. This is a world that was shaped by supply because of big mega force. AI we thought was like inflationary before, it's going to be deflationary, and the geopolitical fragmentation is the world becoming less efficient from an economic perspective, and as a result, cost on an ongoing basis, being higher, and that pushing inflation. So that was the basis. We thought that the Fed would be cutting rates. It's not because necessarily we thought it was obvious from a macro perspective that it was needed, but like that was pretty much baked in. And I think we're going to be now questioning those cuts because of the environment is going to look very different from an inflation perspective, but I still think we're going to see a response that's going to be more muted relative to the inflation shock we're going to get. So yes, maybe we recalibrate monetary policy, but not enough to avoid the inflation.
How much is the move in the long end of the yield curve tied to inflation expectations longer term, and how much is it tied to fiscal deficits and the widening of them in response to trying to stave off some of the cost of living concerns that people around the world are having?
Yeah, I think it's difficult to distinguish which one is the main driver. I see that more as it's a package. It's a narrative that was one where, the world is in a benign inflation trajectory. Yes, there might be deficits, but markets don't really care about this, and so that's where we were before, the last 2 weeks. And now it's a shift in narrative. So we're going to see more inflation. Yes, it's going to be more of a headline inflation story than core inflation, but it changes the perception. And then the debt level, we've been talking about this as well. Debt was requiring, in our view, a greater risk compensation for taking duration risk in this environment. It was not happening. It was kind of a puzzle why we didn't see more of that normalization. And I think now, people look at the spending for the war and so on, and that starts to change the narrative. So I think very difficult to distinguish, but you see a combination of, challenge to a narrative that go all in the direction of somewhat higher rates from here.
You still like infrastructure sectors in Europe, but once again, Europe is hit with another massive energy. LNG from Qatar is going to be incredibly difficult to get to Europe. They don't have the pipeline flows they used to have from Russia. How challenging is it to invest in Europe right now?
Well, I think for the infrastructure piece of the thesis, that I think that adds to it, right? So this is about what will be the long-term lessons from the last 2 weeks. I think we're going to see a different behavior with respect to energy. I think there's going to be even more of a move towards some kind of self-sufficiency, try to avoid some of the dependencies that have been highlighted, and that's about infrastructure. So I think we're going to see some longer-term, development on that front that are on the infrastructure side. But to your other point, I think this is a lot more challenging for Europe, what's happening now, than it is for the U.S. So as a macro story, it is much more damaging for Europe. It's not surprising that the market in Europe is responding much more. You mentioned earlier the equity market seems to be looking through that. Yeah. That's true for U.S., but in Europe, we're still accumulating losses day after day there. So I think in line with this.
John, it's good to see you. It always is. Thanks for dropping by, sir. Jean Boivin there of BlackRock. Now, when we quote futures, we're quoting the front month. So Brent crude right now is at about 96.80. And we've been comfortable with this story because the December contract, which is really where the equity story is going to come from, the anticipatory asset class, the nature of stocks, has been trading much lower than that. The December contract at the moment trades at about 78. But if you experience fourth quarter prices, $12 north of that, in the 90s plus, which ultimately is the forecast from Goldman if this goes 2 months, how much has the world changed? And under those conditions, can the stock market really ignore the story if you start to see a bigger move further out?
Steve Auth of Federated Hermes said that was sort of the line in the sand for him. $90 a barrel on average for the United States would curtail growth, would actually curtail consumption. How many people start to come around to that as those forward prices start to change?
Brent crude this morning, 96.98, just short of 97. We're up by 5% on the session. Up next on the program, fighting to the finish.
The International Energy Agency agreed to coordinate the release of a record 400 million barrels of oil. Oil prices are already coming back down, and it's going to come down, but we're not leaving until that job is finished, and it's going to be very fast.
Up next, we'll catch up with Libby Cantrill of Pimco, live from New York City this morning. Good morning. Crude still climbing, 97 through triple digits once again overnight. 97.03 on Brent, call it 0.5, up by more than 5%. WTI 81.70 and up by 5% also. This from Jeff Curry of Carlisle just yesterday. Policy options are not going to break crude descent while the Strait is closed. The German foreign minister saying nobody here in the region sees themselves in a position to provide the appropriate protection through that waterway.
Yeah, and that's the reason why people are not talking about an easy reopening of the Strait of Hormuz. The policy response has been massive, 400 million barrels being released from the IEA in terms of the European region, and that alone has not really suppressed prices. So what will?
Under surveillance this morning, fighting to the finish.
The International Energy Agency agreed to coordinate the release of a record 400 million barrels of oil, which will substantially reduce the oil prices as we end this threat to America and this threat to the world. We don't want to leave early, do we? We got to finish the job, right? Oil prices are already coming back down, and it's going to come down, but we're not leaving until that job is finished, and it's going to be very fast.
So here's the latest this morning. Crude climbing even as President Trump vows to lower prices with a massive release from the U.S. Strategic Petroleum Reserve. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, as we see this coordinated action from the International Energy Agency, the executive director of the IEA came out and said that the number one thing that could be done to stabilize oil markets would, of course, be a resumption of traffic through the Strait of Hormuz. But as we continue to see disruptions, the Trump administration is now set to release 172 million barrels from the Strategic Petroleum Reserve. But our own analysts at Bloomberg Economics say that the total full coordinated release of 400 million barrels only amounts to about 20 days of flows through the strait. That, of course, is raising questions about the duration of this, as the U.S. Energy Secretary Christopher Wright says that it will take the U.S. about 4 months to fully deliver the supplies. Still, with that said, we are expecting President Trump to come out with perhaps some more details about how this mission is going to continue, as he says that the U.S. could be ahead of schedule.
Tyler Kendall in Washington. Tyler, thank you. Libby Cantrill at Pimco with this to say. The longer this conflict plays out, the more ugly the political environment may become. Libby joins us around the table. Libby, good morning. It's good to see you.
Good morning.
What do you make of the policy response so far?
Yeah, so I think, the expectation was that there would be a dramatic release from the Strategic Petroleum Reserve, and of course that's what we have seen. I do think that, as your previous guests have pointed out, that is only so effective. In terms of other tools, the president is pretty limited. There are obviously Russian sanctions that he can tweak. We saw a little bit of that last week. Export controls, that's really an extreme. Some modifications or exemptions to the Jones Act. But outside of this is sort of all nibbling around the edges in terms of really addressing the, what looks like maybe $100 oil, and of course then the price of gas, which is really the issue politically, domestically. And this is exactly the opposite of what Republicans' plan was for 2026. It was going to be all about affordability. It was going to be pushing their agenda. Even if maybe they weren't able to get things done, they were going to be at least rhetorically talking about it. And now that's been, completely kind of undermined by this.
We came into the new year with the White House squarely focused on affordability. How do they change their message now, going into the summer and going to the midterms, where it's clear the House likely is going to flip? But I'm talking to people who think that there is a chance Republicans lose the Senate.
Yeah, so I think this is sort of their sort of best laid plans here have gone a bit awry. I think what the hope is that this is going to be able to be finished, right, going into the summer months. Now, of course, it sounds sort of flippant, but wars or conflicts are easy to start, much harder to finish, particularly given the complexity of this region. So that intention, of course, may not be realized. I do think, though, just again, you saw a little bit of this yesterday with President Trump trying to get back onto that sort of affordability mantle. But again, people, voters are not stupid, right? They see what's happening. The price of the pump. I just can't reinforce this enough, because if you go back to spring of 2022 and you had almost $5 oil in sort of June of 2022, the president's approval rating, President Biden at that point, it took a huge hit, and they're basically inversely correlated. Mm-hmm. If you look at the graph of a presidential approval rating versus the price of gas, these things, gas and groceries, people really care about these kitchen table issues. And so, people may not be paying attention to exactly what's happening from a foreign policy perspective and in terms of some maybe the wins that the U.S. may ultimately achieve, but they really do care about the price at the pump. And this is going to be a big headwind going into the midterms.
And Biden was then forced to abandon another foreign policy priority, which was to make Saudi Arabia or Mohammed bin Salman a pariah, and he actually went to Jeddah. When it comes to potentially what the U.S. is going to have to, or the administration is going to have Congress for, is there appetite for more defense spending going into the midterm
This
election?
is going to be a very difficult vote, I think. I mean, what it looks like is that the White House is preparing what's called a supplemental package. Could be $50 billion, could be more, honestly, just given sort of the pace of spending and the extent of the conflict. They will probably, as Annmarie knows, they usually like to add sweeteners in order to get that 60 votes. That's what they need in the Senate. Republicans only have 53 votes right now, so kind of by definition, you need 8 Democrats because Rand Paul will probably vote against it. It will be a very difficult vote, and it just means that more deficit spending, right? It means that we could see a supplemental in sort of the $100 billion range, potentially. So I think it's going to be a very, tricky vote. I think going back, though, to your excellent point, though, about the Senate, and this is something, we've been looking at 2 big indicators going into the midterm elections that sort of have correlated with previous election outcomes. One is just called the generic ballot, sort of the general view of one party over another. And the other is an enthusiasm gap. How enthusiastic are one set of voters over another? And, the generic ballot, it's sort of +5 for Democrats. That's sort of like pointing to a fine night, probably the House flipping, but Republicans keeping the Senate. The enthusiasm gap, however, that is suggesting a wave election. And so those are just sort of 2 variables to sort of look at as we go into the midterm election. But to your point, I think the conventional wisdom, Republicans would keep the Senate because of that challenging map for Democrats. That could be thrown out the window, again, the longer this persists.
The Iran war has definitely taken a lot of the energy of everyone's agendas recently, but the government's still in partial shutdown, and if you want to travel, not only is it going to cost you more because of higher oil prices, but also the lines are going to take you potentially substantially longer because TSA agents are not showing up. When are they going to get it reopened?
Yeah, I mean, this is, I think, fault on both sides, honestly, Republicans and Democrats. You can probably say that about a lot on Washington these days. And again, people's view of Congress just in general, it's like at all-time lows. And this is just going to make them more angry, right? I mean, this idea, and this is just, the way to sort of disenfranchise voters is to make things that used to be more convenient, less convenient. Miserable. So again, price of gas now, if you can afford, an airplane ticket, which is obviously going to be higher, now making you wait in line. So I think we all hope that there is some resolution, but it does feel a little bit intractable because of what Democrats want on the ice. Now, I think that politically speaking, if you look at sort of the breakdown of President Trump's approval ratings, one issue where he did consistently pull above water was on immigration, and that has changed over the last 3 months. And you are already seeing this pivot away from some of the stronger rhetoric about deportations to kind of a softer, gentler immigration approach. And so you could I think you could sort of see the White House trying to kind of come to a deal on immigration to sort of maybe pivot some of that more draconian rhetoric.
The turnaround is crazy there. That was such a successful campaign promise, and it's become a losing issue. Just like that.
There's so many issues that a lot of people agree with, execution that people don't.
Libby, good to see you. Libby Cantrill there of Pimco. Equity futures this morning, negative 0.5%. In the commodity market right now, Brent crude up by close to 6%. We're tracking this story closely throughout the day here on Bloomberg TV. Brent 97.32 overnight, 101.59. A brief trip back into triple digits on WTI, up by 5% also. That's how the stage is set in the commodity market. This is the story as it plays out in the stock market. Equity futures down across the board by 0.5 on the S&P, negative 1 full percentage point on the Russell. In the bond market, can this bond market afford another war? The 10-year bond yield right now is 4.22. The Yale Budget Lab executive director said this on the shrinking appeal of U.S. debt. Here's the quote. "We are currently the boyfriend at the beginning of the Hallmark movie in the big city, where the girlfriend is still going out with him, even though she knows it's wrong."
This is the idea of potentially people choosing to buy other assets, in particular gold, and that's something that Jeff Curry was talking about, rather than on the margins putting it back into U.S. assets. I don't know if it's the U.S. being an unreliable boyfriend who then ends up being dumped by the end. I will say that the war is not adding to some of the fiscal concerns, given the fact that the U.S. just in the first 6 days spent more than $11 billion on mainly munitions and is estimated by a number of different analysts to be spending about $1 billion a day. So where is this going to come from? It doesn't make the U.S. a more reliable thing.
I love the quote because it is a guilty pleasure of mine.
He loves a Hallmark
Love a Hallmark movie.
Like, I've seen that one 5 times.
When it gets close to Christmas, don't you love a Hallmark movie?
But I thought they end up with the boy. So
no, they end up with the guy in the farm town.
Oh, you're right. When they go
village,
home for Christmas.
Because she goes to work on a ranch. Often she works in private equity and she needs to buy an asset and take it over from an owner who's had it for generations. And she ends up falling in love with him. And that's how it goes.
Okay, so the ending
Back into her hometown.
Understood.
There you go. That's the plot for basically every single movie.
Every single Hallmark movie will never seem the same. You'll be thinking about U.S. debt instead of whether the boyfriend is
There you go. Yeah, true.
It's true.
True. So you'll start watching them.
Now I'm just thinking how I'm dating all the wrong people, but yeah.
2 hours away from the cash open. Let's get you some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. This morning, looking at Morgan Stanley shares are down 2% late yesterday, writing a letter to shareholders of their BDC, North Haven, that they're going to be gating redemptions at 5%. It's the stress we've seen in private credit, and whether that's the underlying or not, or just sentiment, it means more people are trying to pull out of these retail-oriented funds. I spoke with Goldman Sachs head of credit last week, who said that these gates are a feature, not a bug, and it's designed for these only semi-liquid or not very liquid products. Elsewhere, on the move to the upside, the fertilizer companies are moving higher after having a very good day yesterday. Mosaic was the best performer in the S&P yesterday. CF Industries was the third best after Oracle yesterday. They move higher again today, 4.6% and 3.5%, because the Strait of Hormuz isn't just a choke point for energy, but fertilizer as well. And there have been reports of stockpiling in Turkey and some of their fertilizers curbing exports. Finally, shares of Bumble surging this morning, up 23.5%. They had earnings, fourth quarter showed some stabilization, but the thing that seems to have gotten this market very excited, back to the Hallmark movie in a different twist of this, it's unleashing an AI matchmaking agent. It's going to collect profile data from people, and the AI's going to match people together, and that's the new world we live in. John.
And Danny, this is not about looks, it's about personality, is that right?
Of course. That's all.
Yes,
that's
of
always
course.
the case for these apps, John.
Absolutely. That's what it's all about, without a doubt. Danny, with the latest there.
Bumble is different than Tinder. I mean, come on, let's be honest.
I've never been on these apps.
Look, the thing is, the reputation around each of them, if someone's trying to find someone, I think it's like, you put your AI bot on your taxes, you put your AI bot on your love life. It's, same. Robots.
A married man. I couldn't tell you what happens on Tinder. No idea. The app's never been on the phone.
Thank you for letting us know, John.
All right, Mrs. Ferro's watching this morning. She knows that anyway. On our radar this morning, crude prices rising following additional attacks on the oil tankers off the coast of Iraq. The latest strikes forcing the nation's oil terminals to suspend operations, fueling global supply concerns. Elsewhere, the White House pledging to release 172 million barrels of crude in an effort to combat costs.
The releases, certainly out of the U.S. Strategic Petroleum Reserve, they'll go over about 4 months. But this conflict, I don't think, goes that long. I think we will have the Straits of Hormuz open well before then. Hopefully in the next few weeks, we will see ship traffic returning.
We don't see much of that right now. The release is part of the IEA effort to discharge a total of 400 million barrels from reserves. And finally, the president, confident the injection will ease pricing and vows to keep the pressure on Iran until the job is done.
Oil prices are already coming back down, and it's going to come down, but we're not leaving until that job is finished, and it's going to be very fast. As we end this threat to America and this threat to the world, we don't want to leave early, do we? We got to finish the job, right?
The IEA saying the conflict is, quote, creating the largest supply disruption in the history of the global oil market.
Yeah, and interfering with about 7.5% of global supply. And a real question is, how long is it going to take to bring some of this supply back online? Look, there has been a question of when President Trump would capitulate or taco. Trump always chickens out. That's sort of the notes and the tenor of the notes that we've been getting, and decide, OK, I can declare victory. Given the rhetoric coming from Iran, and given sort of all guns a-blazing, literally, into the Straits of Hormuz, the attacks in Iraqi water space on some of the ships there gives a sense they want to make this worse before it gets better, which is reason why the tone is shifting back to who is it that can say this is truly over.
It's because the regime knows what the threshold is for this administration, and it's $100 a barrel when it comes to oil. But it was interesting yesterday, the president changed his tune slightly from the morning to the evening. In the morning, it's practically nothing left to target in Iran, thinking that potentially where his head was there's going to be a wind down. To the evening saying basically, well, we're not going to leave until the job is done. So basically telling Americans, hang with me a little bit longer, elevated prices because the job is not done yet.
Triple digits overnight. Brent at the moment, 96.86. Global bonds are raising year-to-date gains as elevated energy prices and slowing growth raises stagflation fears. Stephen Mater of Tradition Dubai writing the following. The spectre of stagflation is no longer just a ghost story from the 1970s. It is rapidly becoming the primary concern for global bond markets. Steve joins us now for more. Steve, welcome back. Tense time where you are, so thanks for making time for us this morning. What does that scenario mean potentially for Treasuries?
Well, I don't like using the word stagflation, John, and in fact, I do it reluctantly. But it's just that markets have to price in the scenarios in the same way that central banks are dealing with scenarios. And if we had this call a few weeks ago, I think we spoke actually in January, the oil price was heading down. There was a supply glut and people were talking 60, 50 for oil, right? So here we are with a very different situation. There's a block in the flow of oil, and you can see it's going to take some time to ease that block. The stagflation scenario, I think, has to be taken very carefully because things are different in many ways. The US is a big oil producer. There's a much older population now than back then. There's more wealth inequality. You've got the technology backdrop as well, which is very different. So I look at it and I think we can use the 1970s to some extent, but it does feel to me like the market is pricing in now a lot of that stagflation risk. And what I've been doing is looking at where I think it's in the price and where it isn't. It's interesting to look at inflation break-evens, for example, to look at the different credit sectors, to look at global bonds. But the market wants to price in that stagflation scenario. And let's just say it looks like a 40-50% probability weighting today, whereas it may have been less than 10% at the start of this year.
Steve, in many ways, you're in the fog of war. And I wonder when you speak to people in different places, old colleagues in London, in Asia, in the United States, are you sensing a different perspective over what is happening?
Yeah, look, this reminds me of COVID to some extent. I think I may have spoken to you from quarantine. So the context is a bit different this time. At least I'm free to move around. But it feels a bit surreal. We're waiting on the news flow. And you've got different contexts in that, families will look at this differently to people like myself. I'm here on my own. So we can't judge what people are doing because everyone's different. So it strikes me that this is creating a bit of a growth shock, not just here in the region, but globally. So we're going to have to downgrade growth forecasts everywhere. The question is whether we get tipped into recession or even, dare I say it again, that stagflation scenario keeps coming through. But talking to colleagues, I think that the comparison with COVID keeps coming back. One of the big differences, John, is that we have a decent real yield these days. Don't forget, in 2021-22, we had US real yields minus 100, minus 300 in the UK. Now we've got pushing towards plus 200 in the US. That's quite a juicy real yield. So things are very different in that sense, at least.
Are people pricing in bigger fiscal deficits? You're talking about a real yields and sort of the premium. Is that coming from increased deficit spending, certainly in Europe, but just as much, if not more so, in the U.S.?
I think you're right, Lisa. Some of the risk premium is fiscal because fiscal is not improving. And it seems that fiscal policy is going to be used more, maybe to try and offset the oil price increase, for example, right? And that could happen globally, because that's a typical emerging markets playbook, actually, to use fiscal to control prices. So I think that some of the risk premium is that. But don't forget, a few weeks ago, we would have been talking about AI. Part of the real yield elevation is maybe productivity as well. The thing that matters to me is that the real yield is high enough now to be covering what we think the longer run equilibrium policy rate probably is. And that's what matters, right? For an investor, entering into real yields close to 2, that seems like a great opportunity. And I think that people are going to be buying tips here because they like the real yield and that they're thinking that maybe the inflation expectation could rise.
Given the tail risks here, which have gotten wider and wider, I'm just wondering how big the range of your potential projections for longer term yields could be. Has it gotten a lot wider? Have you actually narrowed it down to actually being above a certain level as being most probable?
Look, it's quite impressive how tight that range is, because I think that we've been in very narrow ranges, right? We had a brief dip below 4% this year, and I think that the way things were set up before this conflict, we were heading to 3.5. I think that if you look through the immediate noise, you're still going to have lower rates, and yields, in my mind, should be below 4. I think a 3 handle is much more natural for the US 10-year Treasury, given the outlook for rates. But look, what's going on at the moment means that there's going to be a pause. Well, no central bank is going to rush to do anything here apart from update their scenarios. That's all that's going to happen. There'll be no rate action. There aren't going to be any hikes. The question is when we can get back onto the easing path.
Stephen, given the fact that you're actually in the region, when you talk about a specter of stagflation, have you found it difficult to convince other individuals, your peers that are around the world?
Yeah, I think that stagflation gets a bad rap, and I've not been a big fan of it as a scenario. I think it's quite lazy that people reach for comparisons with the 1970s when it's so different. But there's something in this now. I think that the definition of stagflation requires there to be a recession, rising unemployment, and inflation that's going up. We're not there yet because the US numbers are still quite resilient. So there may be some sort of form of stagflation light coming into the valuations. But I'm surprised that you haven't seen more rotations in the credit market, more kind of sectoral shifts into safety, more moves up in quality, for example, or into those sectors that are more safe, like non-cyclical type of things. I'm quite surprised about that. And also, of course, the equity market has held up pretty well as well. It could be quite dangerous to be seeing this as a buy the dip in all the risk assets. And I know that that's something that the markets have become conditioned to do because they've been rewarded every time in the past. But this could take some time to work through.
Well, Steve, let's just talk about what's happening in fixed income at the moment. This week, we had one of the biggest days of supply, in fact, the biggest day of investment-grade credit supply in America that we've ever seen. We had a massive issue come from a single issuer, Amazon. But also, when you look at spreads, IG spreads are tight, high-yield spreads are tight. Even with some problems emerging in private markets, you're not seeing that contagion into the rest of, say, fixed income, Steve. How are you weighing the risks that are emerging elsewhere too?
I think it's really impressive that these jumbo deals get done. I mean, even thinking about the UK gilt, for example, and again, the demand for these bonds is just huge. So it seems to me that the safer sovereign bonds are doing just fine. The top quality corporates are going to do just fine. I mean, people like those household names, and so they're going to buy Amazon and anything like it. The private credit side is really interesting because that would have been the dominant story this week. Maybe it still is, and there are echoes here of 2007. And I think that in the discussion and before I came on air, I think you were talking about some film, or you call it movie over there, don't you? But you were talking about the unreliable boyfriend being in private equity. Well, actually, maybe he should be in private credit, because that seems to me to be the focus right now. In that could spill into public credit markets, and if that happens, then you're going to see bonds in the government sector get bid, and bonds will start performing better than swaps and better than credit.
You'll remember from your days in London, we used to call Mark Carney the unreliable boyfriend. Do you remember that, Steve? It's been a long time. Steve, it's good to see you. Stay safe, buddy, and thanks for making time for us. Steve Major there of Tradition Dubai on fixed income. 10-year Treasuries, the low of the year, 392, came at the very start of this month.
Yeah, and just how far we have come, given the fact that we've risen, almost 30 basis points in that time. And it's come on this idea that we're going to get an inflationary shock from oil that could cause central banks to remain on hold or hike rates, which would slow growth in the long term, which raises a question. Why are people pricing in inflation over the long term, and when will they start bidding treasuries back? And as Steve Major was saying, it's not until they feel the fear that will be expressed in risk markets that right now are anything but fearful.
Steve said what you said, that if we weren't talking about the Middle East, we'd be talking about private credit. I agree with you both.
I think there's a liquidity issue here, which is very clear. They don't want to sell assets to meet redemptions at the pace that they're getting them. There's clear fear in retail investors, which has been a driver of the expansion. And on the flip side, we're potentially going to see credit issues coming from the higher oil prices.
The Federal Reserve stuck between a rock and a hard place. Up next on the program, balancing the dual mandate.
Both on goods and energy, we have a problem. Futures markets are pricing in the idea that some sort of settlement will occur before the end of the year. I think the Federal Reserve should just stay on hold here. All the problems that the economy is facing have got nothing to do with the level of interest rates.
Up next, we'll catch up with Sonal Desai of Franklin Templeton, live from New York City. You're watching Bloomberg Surveillance. Brent crude just short of 98 at the moment, 97.60, and up by 6% on the session so far. The highs overnight up by 10. WTI 5.6% higher, 92.20 on WTI crude this morning. Equity futures off the back of that. Bit snoozy on the S&P 500, negative by 0.4%. On the Nasdaq, down by 0.4. The pain, if you can call it that, on a Rystad or small caps, down by 1 full percentage point. And if you check out the bond market, you wouldn't know anything was going on. Yields are just about lower by a basis point through the curve. We're down on 10s to 421 and on 2s to 364.
Macro paralysis right now. How do you respond to a stagflationary shock that may or may not be long-lasting? And right now, the market's saying we're not going to put a lot of conviction behind this one.
Fed meeting a week away. The Federal Reserve getting together next Wednesday. Under surveillance this morning, balancing the dual mandate.
Both on goods and energy, we have a problem. Futures markets are pricing in the idea that some sort of settlement will occur before the end of the year. We've also got a problem, though, in goods because we still have tariffs, and I think you're going to see the feed-through effects of tariffs affecting inflation. I think the Federal Reserve should just stay on hold here. All the problems that the economy is facing have got nothing to do with the level of interest rates.
So here's the latest this morning. Energy price shocks adding to inflation fears ahead of the Federal Reserve's decision next week. Sonal Desai of Franklin Templeton writing higher oil prices are likely to lift inflation expectations quickly, prompting markets to price in a less dovish stance from the Federal Reserve. Sonal joins us now for more. Sonal, we're seeing that, and not just at the Fed, we're seeing it at the ECB, at the Bank of England. That's the front end of the curve. That's that story. Further out, when you look at something like a 10-year maturity, is this shock bullish or bearish, positive or negative for bonds?
It's bearish. I think it's bearish for bonds because we keep hearing about the potential stag part of stagflation. I actually am a little bit less concerned about that if we're talking about the US. The euro area is a little bit different. But if we're looking at the US, just to put things a little bit in perspective here, John, so far, as you noted, we've got Brent at around 97. The average price of Brent in 2022 was 100. And I would note that we came into 2022 with inflation already at 7.5% in January. And inflation rose, definitely. And it went up to something like 9.5%. But I'm just trying to put things a little bit in perspective here, because we didn't get a recession out of all of that. And I think while we shouldn't underestimate the gravity of everything we're seeing, I think it's premature perhaps to overestimate it. So to some extent, I actually think the market's getting it right here.
Well, that sort of explains why we haven't seen any kind of fear expressed in credit markets. In fact, they seem to be wide open, and I'm putting private credit aside. I'm talking about public credit markets. Do you think that that is poised to change if the long end of the yield curve continues to sell off and oil prices remain high, or do you think that the market's getting it right and this will be temporary?
So that's pretty much calling the end of the conflict, the war, and that's fairly hard to do. I think currently at markets, the best estimates markets are making is roughly around, most people assume 6 weeks, maybe a couple of months. And I think for that, we can actually overcome this. And I do think there's an extent to which, if we're looking at public markets, they're looking at the underlying fundamentals. And I don't think very much in the underlying fundamentals has changed via what's happening in the Middle East. Enormously disruptive as it is, the underlying fundamentals actually haven't dramatically changed over the last 13 days.
Sonal, are you concerned that some of what we're hearing in private credit markets, the idea of redemptions and gates and all sorts of other headlines that keep crossing every single day, will start to infect appetite in public markets?
You know, this is a difficult one because fundamentally, when I look at private credit, the fact that it is illiquid is pretty much written on the can. It's supposed to be illiquid. That is that asset class. And in that asset class, if you do get a lot of redemptions in one go, you are going to get liquidity issues. Do those translate immediately into insolvency issues? I'm less sure, because these products are designed to be, by their nature, somewhat illiquid. The fact that they cannot meet redemptions on demand largely is also baked into the cake, because they're not really supposed to. It doesn't give you that much of information on the underlying asset quality. I think the real problem is, again, somewhat by nature, this is a fairly non-transparent asset class. You can't know everything which is in there, and you can't know the price of everything which is there because it doesn't trade. So I look at this, and yes, I'm concerned, but I don't think we're at the stage of saying that all private credit is catastrophic, because quite honestly, we don't know.
Sonal, it's good to see you, as always. Sonal Desai there at Franklin Templeton on fixed income. Some headlines crossed on a Bloomberg terminal just months ago. Comes from the Energy Secretary, Chris Wright, speaking to American media a little bit earlier on this morning, reiterating that the operations in Iran will take weeks and not months. Going on to say this about escorts through the Strait of Hormuz. The Navy escort will happen relatively soon. It can't happen now. The tanker escort is likely by the end of the month. The guidance coming from the Energy Secretary, for whatever that guidance is worth this morning.
That's actually really significant, giving a timeline for when they could try to get that traffic going again, how much money goes behind that. And this, of course, comes after what we saw earlier with the tweet that then was retracted. So clearly this has been in the works. It's just that they're laying the groundwork for it, and it just can't happen just yet.
That is highly dependent on the operation and how long the operation goes on for, and whether you believe it's going to take weeks and not months.
And also, what does this actually look like? It's not going to be all the tankers all at once. This is a very narrow strait, and it's going to be single tanker at a time. It's going to be very slow.
Coming up on the programme, we'll catch up with Ohsung Kwon of Wells Fargo, Gerard Cassidy of RBC, Nela Richardson of ADP, and Oksana Aronov of JPMorgan. The third hour of Bloomberg Surveillance, up next.
There's a systematic upward bias in equity markets.
The market is trying to look through the valley here.
If it's a 1 month shock, the market has to price in the risk that it might be 2 months.
There's just been absolute violence in terms of the rotation.
Be watchful rather than making massive structural changes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The opening bell about 90 minutes away. The data about 30 away. Jobless claims at 8:30 Eastern Time. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now, with equity futures on the S&P negative by about 0.5%. Likewise on the Nasdaq. On the Russell, the small caps underperforming throughout this morning. We're down by 1 full percentage point there. In the commodity markets, setting the tone for things. Triple digits overnight on Brent, 98. We're climbing again this morning by 6.6% on Brent crude. The Energy Secretary, Chris Wright, speaking just moments ago, speaking to the American press and saying that ultimately this operation will take weeks and not months. His call, up to you as to whether you believe that or not. And the Navy escort they've talked a lot about won't happen right now, but will happen relatively soon and could happen, likely, by the end of the month.
There are 100 ships that before this conflict were going through the Strait of Hormuz every single day. So to escort even a small proportion of that requires a significant amount of manpower and requires a huge amount of logistics. So that could be potentially a lever to offset some of the lack of flow. The bottom line is, though, until there is a resolution to this conflict, people are all caught up in the fog of war, unknowing the duration as well as the ramifications from an economic impact. And that's the reason why people might seem complacent, but the conversations that we're having are anything but.
And it's the reason why oil prices are going up, even after the IEA came out and said we're going to have this 400 million barrel a day drop, even after the president and the DOE came out and said we're tapping the SPR. Yesterday, he talked about flows when it comes to Jeff Curry in that conversation. And right now, there's a mismatch if the Strait of Hormuz effectively remains shut.
Look at the situation right now. This is not just Israel, Iran and the United States. There's other Gulf nations that have been pulled into this as well. Our colleagues are working from home today in Dubai. We've seen banks like Citi, Goldman, Standard Chartered tell their staff to do exactly the same, because this war zone is not just in Iran. Iran is bringing everybody else into this mess, which is putting huge amounts of pressure on supply chains in the region. Asia is the first one to suffer by a lot. They've got a decent cushion to deal with things, sure, but you're seeing it not just in oil, but oil product, and the pressure keeps building, which is why we've now got Brent back to about 98. But I don't think Brent's the story, actually, this morning, at the front end of the curve. I think the story is further out along the curve. The fact that December futures are now talking about potentially 80, the high 70s, and you've got real analysts in this oil market, Goldman, coming out and saying, if this lasts an extra month, let's say it goes 60 days, then we're talking about averaging in the 90s in the fourth quarter. That's not where the equity market is, but will it be there in a few days' time?
Especially if you start to see moves from the central bank or lack thereof in terms of how they can potentially respond, and if Iran continues to ramp up some of their attacks. If oil prices remain at that level, it's not just oil. And I think we have to keep coming back to this. 40 to 50% of urea, which is a key ingredient in fertilizer, goes through the Strait of Hormuz. There are other shipping containers also that have been unable to go through that port. So it's not just supply chains for oil. It's supply chains for food. It's supply chains for all sorts of other materials and supplies. This is the reason why the market's not coming around to this yet, but it could potentially be a real shock.
And we're already seeing the knock-on effects. Look at what Willie Walsh is talking about. 8 to 9% is the jump that you can likely expect when it comes to airline fees. And we're only 13 days into this. Jet fuel is going higher, diesel's going higher. All of this is trickling down to the products.
Brent crude right now, 98. Coming up this hour, Ohsung Kwon of Wells Fargo with stocks heading for a third straight day of losses. Gerard Cassidy of RBC Capital Markets as stress is building in the private credit market. And Nela Richardson of ADP breaking down the latest jobs data. We begin this hour with stocks lower and crude rising as the historic release of oil reserves is failing to outweigh tensions in the Middle East. Bloomberg's Tyler Kendall has more for us this morning. Morning, Tyler.
Hey, John, good morning. Well, disruptions are continuing in the Strait of Hormuz as the International Energy Agency came out with a report this morning saying that the current disruption to global oil supplies is the worst in history. As you mentioned, we heard from the U.S. Energy Secretary moments ago suggesting the U.S. could soon escort tankers through the straits with the Navy, but isn't quite ready to do so yet. This as the administration is set to release 172 million barrels of oil from the Strategic Petroleum Reserve, which U.S. officials say will take about 4 months to fully deliver. The conflict is showing no signs of abating as President Trump yesterday re-suggested that the conflict could still end, but maintained that he is prepared to sustain the military operation for as long as it takes. And Israel confirmed earlier today that they have started a new wave of large-scale attacks, including targeting one Iranian nuclear facility. Plus, on Iran's end, we're starting to see more escalation around the region, including hitting energy and security infrastructure, as reports that 2 Iraqi crude tankers were hit in an attack overnight. Now, John, there is reporting that through regional intermediaries, according to people familiar telling Bloomberg News, that Iran has outlined some key conditions they would need to be met for a ceasefire, including that the U.S. and Israel would pledge to never attack the country in the future. At this point, it just feels like both sides are very far apart.
Tyler Kendall with the latest in Washington. Tyler, thank you. Stay close. Here's the view on Wall Street. Ohsung Kwon of Wells Fargo writing, it's a U.S. war. The U.S. arguably has more control. De-escalation is bullish, but upside likely capped at 7K amid AI and private credit fears. Ohsung joins us now for more. Ohsung, good morning to you.
Good morning.
Let's start with the December Brent contract. It's trading around 80. Is this getting harder to ignore, or can you continue to look through this?
Yeah, no, I think you're right. I think it really depends on the duration of this. Is it weeks? Is it months? If it's weeks and we're back to like 7-ish Brent crude, then I think we're sort of back to normal-ish macro cycle. And I think the underlying macro cycle was pretty healthy before this happened, right? I mean, we were talking about the manufacturing upcycle for the first time in three years. We were in a restocking cycle. The consumer was about to get a lot of cash from the tax return too, which is happening right now. So I think the underlying macro cycle is still pretty healthy. There are some bull cases too. Everyone's talking about bear cases, but there are some bull cases from the macro cycle. Everyone is hedged. There has been a lot of hedging activity happening, so the downside protection is there. Number two, liquidity cycle is in an upcycle. So in terms of the domestic liquidity, we're back at January highs, and I think that's what's really making U.S. equities more resilient versus other asset classes.
We can spend some time on the macro backdrop. I'm with you. The ISMs have been pretty decent. Park labour market, everything else has been pretty promising, particularly the fact we get these refunds, and there's a lot of capex behind us as well. But before we get to all of that, when this first started, people were coming on and saying, if it's days and not weeks, it'll be OK. And now we hear, if it's weeks and not months, it'll be OK. It's 13 days. Where on the calendar does it get real for you? Where's there a tipping point?
Yeah, I mean, the administration last week came out and said that it's going to take about 4 weeks. So if it's really 4 weeks, then I think the market's sort of pricing in 4 weeks-ish time frame. Yeah, I mean, I think, a lot of people are starting to talk about the analog of 2022. And I think the macro cycle is very different versus 2022. First of all, we were coming out of the easiest monetary policy in 2022. The oil market had 2 years of deficits in 2020 and 2021, whereas 2025 was a massive surplus. So if this is really like a 4-week event, then I think we're going back to a more normal-ish environment, and I think equities are going to be fine. But at the same time, if this drags on for months, then we're talking about a very different story.
You said that the worst-case scenario now is about 6,000 on the S&P. What are you pricing in? I mean, what's the kind of worst-case scenario to get to that level?
If oil stays at around $100 and people start talking about more of a stagflation narrative, then I think, yeah, the worst-case scenario is going to be about 6,000. The level that we're watching is 6,350 on the S&P 500. That's the VWAP of this bull market so far. So basically, below that level, on average, people are going to be under the water in this equity market. And I think below that, we could potentially see more policy put, which could potentially provide more support to the equity market.
One concern, you mentioned liquidity. Some of that liquidity is getting diverted to compensate for higher oil prices. There also is one aspect of liquidity, which has been share buybacks from a lot of the tech giants. That's increasingly going to building out data centers and investing in their AI build out. Where is additional liquidity going to come from if the fiscal space is really kind of focused on supporting defense, supporting oil prices, and the monetary space is in paralysis?
Yeah, that's the real concern, right? This Iran war really, kind of threw cold water on that liquidity cycle. And it is getting better. I think that's the support that's providing for the equity market. That being said, if this drags longer, obviously that's going to be bad. One area that we're starting to like is the hyperscalers. I think the pain trade actually is the NASDAQ higher. Because positioning is not there. Everyone hated the NASDAQ, including ourselves, for the past few months. We were actually outright bearish hyperscalers for a few months. It's been a funding short of the market. And if you think about last week, there was a real pain trade that happened last week because the macro favorite longs were Kospi, Nikkei, and gold. And all three saw some volatility. And the funding short was really the dollar and the S&P, especially the hyperscalers, right? And I think, so first of all, positioning is not there. Second, fundamentals actually might be inflecting higher. The reason why everyone, including ourselves, were bearish on hyperscalers was because of their free cash flow weakening. And we actually think that at least the CapEx, the second derivative of CapEx revision is probably slowing. I think everyone's underestimating the revenue upside. And if AI is really that good, hyperscalers are probably not over-investing. And I think free cash flow might actually be inflecting higher. If that's the case, I think hyperscalers are all of a sudden looking a lot more attractive.
One of the main input costs to hyperscalers is energy, and that's going up.
Yeah.
Doesn't that concern you?
Yeah, I mean, if you if you think about their overall capex and the energy portion of that, it's actually tiny. It's really still GPUs and memory and things like that. So yeah, it's a headwind, but these companies have so much cash on the balance sheet, and they're also issuing debt to raise to fund the capex as well. And if the revenue growth is there, and everyone's still saying that demand still outpaces supply, and if AI is really that good, then we're just going to need more compute power. So if that's the case, I think, and also all of a sudden, with Iran, hyperscalers and AI trade is now looking like a quality trade again, because they are more insulated from what's happening geopolitically. So I think there will be more flows into those companies.
Ohsung, always good to see you. Appreciate the constructive outlook as well. Ohsung Kwon of Wells Fargo. Coming into this, there were reasons to be bullish. We talked about it so many different times. The tax refunds we'll get, the capex from the big tech players, the cuts to monetary policy, the rate cuts we've seen over the last 12 months plus, all of that building towards a cyclical rebound. Undermining some of that is what could happen here in the Middle East. We're tracking that story for you. Just getting this headline from Tasnim. This is, of course, the semi-official news agency out of Iran, the broadcaster there, that the new supreme leader will issue a first statement, and that statement could come any moment now.
This is the former Ayatollah's son. There's been many speculation about where exactly is he. There was a report yesterday that he's injured but still alive. And this is what the regime has been waiting for. And also individuals in the Gulf just questioning, when are we going to hear from him? We will get a statement. Very interesting what he's going to say, especially given we have a prescription yesterday from the Iranian president on what it would take in terms of the U.S. and Israel doing in order for them to come to the negotiating table.
As those headlines cross, equity futures negative by about 0.6%, Brent crude out to about 98.30, WTI 93.20. When that statement crosses and we get those headlines, we'll bring them to you. But finding out where Iran is on this, we've often talked about this. When we talk about the U.S., we know who we're talking about, the President of the United States. When we're talking about Israel, we know who we're talking about, Netanyahu. We know who has the controls there, who's leading this effort. When we're talking about Iran, things have been very, very confusing because we had conflicting messages coming out over the weekend from the Iranian president and then what the Iranian forces were actually doing.
Yeah, this is the difficulty right now. On one hand, you can say that a lot of the potential leaders and the current leaders were eliminated, as the military would say. On the other hand, yesterday there was a report that the U.S. was discussing that found that actually much of the IRGC leadership really was in place and continuing to harden their line, and you're seeing attacks only escalate in the region. The fact that the new supreme leader is going to put out a statement could simply galvanize some of that spirit behind what we've already seen.
We're on standby for that statement. When we get the headlines, we'll bring them to you. Up next, we'll bring you some morning calls as well, plus Gerard Cassidy of RBC Capital Markets, as stress is building in private credit and what it means for the likes of Morgan Stanley and Goldman Sachs, because those stocks have started to trade a little bit softer over the past few weeks. That's next from New York City this morning. Good morning.
The private credit side is really interesting because that would have been the dominant story this week. Maybe it still is. And there are echoes here of 2007. That could spill into public credit markets. And if that happens, then you're going to see bonds in the government sector get bid. And bonds will start performing better than swaps and better than credit.
We'll come back to that story in a moment. Steve Major there of Tradition Dubai. The story at the moment in the equity market, negative by about 0.6% on the Russell. We're down by 1.3 in the commodity market. Crude, new highs overnight. New highs, I say, relative to where we have been the last couple of days. The high, of course, of the week, 119.50 on Brent. The high overnight, north of 100 again in triple digits, 98.64. We had a statement from the state-affiliated broadcaster in Iran saying that we could get a statement for the supreme leader, the new supreme leader, any moment from now. So we're on standby for that, with crude elevated, up by more than 7%.
So waiting for this statement, we have not heard from the new supreme leader. His father was killed in a strike, the former Ayatollah. And there's been all this speculation. Is this individual even alive? Yesterday was a report that he was injured. So this is going to set the tone potentially for the direction and how long Iran is willing to continue fighting this war.
When we get that statement and those headlines, we'll bring them to you, of course. Let's get you some morning calls. First up, Jeffries lowering its price target on Delta, noting the steep rise in jet fuel prices. Your second call, Wells Fargo, double upgrading Occidental to overweight, believing the energy giant can resume an accelerated growth trend in 2027. And finally, Piper Sandler raising its price target on Exxon to 186. The analyst revising estimates on the back, guess what? Higher crude. That stock is up by 0.75%. Let's turn to the financials. Morgan Stanley and Clifford are limiting redemptions from multi-billion-dollar private credit funds. This coming as the firms grapple with waves of withdrawal requests. Herman Chan of Bloomberg Intelligence joins us now for more. Herman, we've seen one after the other, and maybe there's more to come.
That's right. There's a lot of questions on private credit and the interconnectedness with the banks. And that's really what's driving share price performance over the past few weeks and months, is that there's still a lot of questions on what's going to happen within the private credit complex and questions on how banks will be affected given their exposures to these non-bank financial institutions.
Herman, we've seen some of these names, Morgan Stanley, Goldman Sachs, deliver fantastic earnings in Q4. And the stocks were really outperforming within the financials. They've just started to trade a little bit softer more recently, Herman. Why are they getting caught up in this in a bigger way?
Yeah, I think what you can point to is that the increased volatility is the enemy for lots of businesses like IPOs and M&A. So heading into the year, there was lots of enthusiasm that investment banking activity would ratchet up higher this year, given the fact that we have a big backlog in IPOs and also increased M&A activity given the deregulation efforts of the Trump administration, and also potential return of areas like private equity putting their portfolio companies into the public markets. Given the volatility we see today, a lot of that's on pause in our view.
Herman, good to see you. Herman Chan there of Bloomberg Intelligence. To build on this, Gerard Cassidy of RBC Capital Markets. Gerard, thank you for joining us, sir. Do we have a problem here?
John, yes, there will be some issues, no doubt about it. The private credit problems are likely to continue because of what's going on in the marketplace. But the real question then is, what's the impact of the banks? The banks have some exposure to some of the private credit players, but this is nothing like what we saw back in 2008 and 2009 for the banks. The other thing too, John, we got to remember, when you look at the total private credit markets, it's about a 1.7 trillion globally. And when you think of what happened to the price of crypto in the last, 6 to 9 months, it's lost over $1 trillion of value, and nobody batted an eye. So it's going to be an issue, no doubt about it, but we don't see it as a systemic issue like the subprime crisis was.
Is there a bank, Gerard, that you think, or a class of banks, whether it's small, whether it's medium, whether it's among the largest, that you think is most exposed, not just to the private credit story in the form of credit lines and direct lending themselves, but in the form of sister asset classes, whether it's software assets, whether it's similar types of lending that might come under pressure in response, in sympathy to what we're seeing in private credit?
Lisa, it's an interesting question because that's what we're all looking for, of course, is any second derivatives from a private credit disruption or meltdown, or whatever you'd like to call it. And right now, specifically on software, the exposure to software companies from a loan portfolio for all the major banks is very minimal. So it's not something that we're too worried about. Could there be idiosyncratic pop-ups of credit losses? No doubt about it. But you're asking a good question because it's the loans to non-depository financial institutions where some of these loans lie, and the transparency is not very clear. It's getting better. I think you're going to see better transparency on the first quarter earnings calls, but the banks will tell you that the structures that they're lending into are very senior AAA tranches. So we're not too concerned of any material losses for the big banks. And again, they've been so de-risked since the financial crisis that they'll be able to weather any storm that comes from private credit, in our view.
We did see, though, some concerns after Silicon Valley, particularly with regional banks, about some of their lending portfolios. Putting aside just private credit and specific liquidity concerns, with an oil price shock, there is a fear that liquidity concerns could be paired with real credit concerns if the economy were to deteriorate. Do you have a sense of whether there are pockets of potential pain within the banking system that would emerge in that type of scenario?
It's interesting because the Silicon Valley failures, First Republic and Signature, was so unique. You might recall, Lisa, these companies relied on the uninsured deposit source of funding, and that's what put them out of business. The liquidity problem back in 2023, they were unique. No bank is set up that way. So from a liquidity standpoint, even if price of oil stays over $100 a barrel for an extended period of time, we're not that concerned about a liquidity crisis. However, you do touch on something else, which is credit. So if somebody's forecasting $100 oil for 6 to 12 months, that's likely to lead to some credit issues, particularly at the consumer level. But you would have to have real confidence that that was going to happen. We don't believe that's going to happen. We don't know, though, for sure. But I think if you look at the current state of affairs, we just finished our 30 annual financial institutions conference yesterday. Every bank that presented, first quarter results are going to be good. Everything is on track. So we'll see how this plays out.
You still think the banks are a buy, Gerard?
Yeah, yes. In fact, John, I think this is, you know what? It's interesting, John. This reminds me of Liberation Day. You remember last April, and the bank stocks got hit real hard. And we've, assuming, of course, this Middle East crisis does not extend out for another 9 or 12 months. But if we clean this up or dials back in the next 4 weeks, yes, they're definitely a buy.
There we go. Gerard Cassidy there of RBC Capital Markets. The week of Liberation Week, bank stocks were down something like 14%. Then it bounced back and rallied aggressively from there, as did everything else. But is this really the same as what we saw last year?
I kept thinking in my head, conditioned by experience. This is a market conditioned to not miss out. This is a FOMO-driven market, not exactly one driven by fear. And it's the reason why maybe you're not seeing the scope of the sell-off that you saw in the wake of Liberation Day, because there was a policy response, which is the reason why we keep going back to, is there a clean policy response to this in the same way as in April? And increasingly, the answer is a resounding not at all.
In April, there was only one party waging war. There was no retaliation. It was all in the president's hand. This time around, very different.
You said it best yesterday. It was a lever Trump can pull up and down. He cannot do this here as much as they want to. They cannot even at this moment escort a tanker through the Strait of Hormuz, which is the choke point right now. So no, and everyone that's bullish has an asterisk. Well, it depends how long this lasts.
Weeks. We hope it's weeks now, not months. Things are changing slowly. Coming up on the programme, the latest jobs data, claims set to report in just about 4 minutes' time. We'll get Nela Richardson of ADP with us in just a moment. Tracking a few things this morning, a state-affiliated news agency out of Iran suggesting we could get a statement any moment now from the new supreme leader, so we're standing by for that. In the equity market, going into some jobless claims data, equity futures are negative by about 0.6%, down by 1.3 on the Russell. In the commodity market, 119.50, the high of the week so far. That was Sunday evening. Overnight, triple digits once again, and Brent crude not too far away at the moment, 98.60 and up by more than 7%. We'll get into that in just a moment. Let's talk about the economic backdrop, the jobs market. Mike McKee has more. Morning, Mike.
Good morning, John. Well, the low-fire economy continues. We're at 213,000 for initial jobless claims last week. That's down from a revised 214,000 the week before, and it's just about where we expected to be. So it doesn't suggest that companies are giving up on their employees yet. Continuing claims, 1,850,000. That's down from 1,871 the week before. Other numbers out, a smaller than expected trade deficit for the month of January, negative $54.5 billion. That's down from negative 72.9 in the month of December. Imports were down by 0.7%. Exports up by 5.5%, suggesting there is some tariff effect at work there. Housing starts are out, and they are up 7.2% in the month of January. A big surprise. The anticipation was for a decline of 4.5%. Bad weather, of course, one of the major culprits. Building permits were down 5.4%. The expectation was for negative 3.1%. So more pessimism on the side of builders, but not as much of a weather impact as people thought. So some overall really pretty good news for the economy given where we are at the moment.
We'll take that, Mike McKee, without a doubt, particularly following that dreadful payrolls report just last week. Michael McKee there breaking down jobless claims coming in at 213,000. The estimate was 215. Claims have been really, really stable. And I called it a dreadful jobs report, but over the last 12 months, if you stripped out healthcare, it is pretty ugly out there for hiring.
We would have been in a jobs recession of sorts in a lot of different industries. We've seen a lot of people struggle to find jobs in terms of the time, but the amount of firing hasn't really picked up, and there is this equilibrium because of an aging population and a lack of immigration. I just wonder if this is a good thing or if it just adds to the complication of what we're talking about, certainly for the Federal Reserve. Is there enough here for them to potentially cut rates, be more sensitive to the job side of the market, given the inflationary shock, at least in the near term? And ultimately, the market seems to be suggesting not so much based on the fact there's only one rate cut priced into the market for this year.
Equity futures going into the opening bell about an hour away, negative by 0.7% on the S&P 500. In the bond market, turning to fixed income, yields down by a basis point through the curve, 2s out to 30s, 10s are down about a 1 basis point to 421. And of course, staying on top of crude for you, Brent 98 and up by close to 7% on the session. Nela Richardson of ADP joins us around the table here in New York for more. Nela, good morning.
Good morning.
The labour market. Let's just start with the labour market, then we get to the broader economic backdrop. Just how fragile are things, particularly the insight that we got from the payrolls report over the past week?
You know, John, this is a peculiar time because it's a time when you have to separate a pretty strong labour market with very weak hiring. They are two different things. And if you look at the hiring we've seen, it's been concentrated in certain industries. And so the labor market overall, Mike McKee just reported it, there's very few firings. There's very few layoffs. We're at historical lows. It's pretty strong. It's pretty robust when you look at pay gains. But the hiring is weak. The uncertainty is leading firms to be more cautious. And that is the distinction that is hard for people to get their minds around.
Do you expect those two differences, those conditions to reconcile?
Eventually, sure. I mean, we're actually seeing at ADP a pretty solid hiring path. We reported on Tuesday that as of February 21st, hiring was tracking over the last 4 weeks at about 60,000, which was in line with what we said for the February ADP report. That's very different than what the government is showing right now with that February report. But what you're going to see, I think, is a lot of choppiness. The reason why the markets didn't really respond to this low number for February from the government payrolls is that they averaged January and February, and they got right around what they expected for that 2-month average. And that average is the point for the markets, but it's not the point for Main Street. That volatility matters a lot. And if we are indeed seeing huge swings in hiring from month to month after it's been seasonally adjusted, that is not a great place for workers to be right now.
There also is a sense that a lot of this hiring, as John alluded to, is really concentrated in healthcare. It's concentrated in a couple of industries that are counter-cyclical to any kind of economic growth. Do you see any expansion, broadening out, a sense that this is a broader hiring that can take place eventually when there is some sort of emergence from the stasis?
You know, we actually saw a broadening out in construction jobs, and I think that's a great signal. I mean, you're building forward. Even the housing residential starts that Mike reported showed a bit of signs of life in a cold winter. But that data center investment, that building out of the infrastructure, it is happening. And it's happening at a time when interest rates are where they are, and there is a lot of uncertainty. The physical environment is still moving forward, and I think that's a great sign to hinge like the platform for what's needed for this AI boom to actually take off.
What does this look like if you impose $100 a barrel oil on this backdrop? Does it curtail this? Does it stymie it? Or does it allow just growth at a slower pace?
You know what? another interesting part about the labor market right now, and I think markets in general, is that people are able to look past one-off things. And I'm not saying that this oil price conflict is one-off. I'm just saying they can look through $100 oil and maybe see a future. They can look through higher inflation. They can look through a weak jobs market. They can look through high deficits and high debt. What's hard to look past is the crosswalk between all these things. The multiplier effect of higher oil and higher deficits and higher bond yields on the 30-year, which increases long-term borrowing costs. All of that is hard, especially if you're a small business. And that is where we're seeing the bulk of the hiring right now. It's hard to look past the intersection of all these areas of uncertainty. And I think that's what's going to lead to more choppiness in hiring going forward.
Well, to Lisa's point, just before she asked about oil, you were talking about an expansion in construction working and that sector. Doesn't this potentially put a halt to that if this is a prolonged crisis?
You know, yeah, it does. And energy is driving this boom. Energy drives AI. That AI investment is already slowed by how resource intensive it is. That's why the infrastructure needs to build out. And then I was on Wall Street Week just this past Friday talking about the labor market that is needed to fuel this investment infrastructure boom. It's retiring right now. So you're not seeing the labor supply keep up with the labor demand, even in construction. So this is where the supply constraint is really, really material. And then the last thing I'd like to note just about the overall labor market is that long-term unemployed, those numbers are up 30% from a year ago. So it is still taking longer to find that job. The hiring is so weak that we can't really ingest new people into the workforce right now.
You talked about the cross currents. Where does that leave the Federal Reserve in your mind?
On pause. I think there's too much to digest right now because they really are cross currents. These trends are working in opposite directions. And if you have a 4.4% unemployment rate, and that is your North Star in the labor market, then all the other things are just inflationary pressure. So I think that they are going to really hinge their bets on what they can see. And the unemployment rate is the most concrete of any indicator that they're watching right now.
Nela, always good to see you. A clinic, as always. Nela Richardson there of ADP. A glimmer of hope, some positivity there about hiring. And we hope for sure we see more of that.
Yeah, I have to say, that actually made me feel really good because it's nice to think that it was actually accelerating going into this, not necessarily in this perilous, weakening state that some people have talked about. Is that enough to overcome some sort of price shock? And that ultimately has a lot of potential asterisks and what if and scenarios baked in, but that's what everyone's wondering.
Up next on the programme, we'll break down some of the big moves in financial markets. Triple digits overnight on crude. What does it mean for fixed income? We'll catch up with Oksana Aronov of JPMorgan in just a moment. Plus, we'll get you some morning movers. We'll talk about private credit. Morgan Stanley sliding in the pre-market. That name slightly softer this morning. From New York City, you're watching Bloomberg TV.
We keep hearing about the potential stag part of stagflation. I actually am a little bit less concerned about that. We've got Brent at around 97. The average price of Brent in 2022 was 100. We didn't get a recession out of all of that. While we shouldn't underestimate the gravity of everything we're seeing, I think it's premature perhaps to overestimate it.
That was Sonal Desai of Franklin Templeton. Things are still pretty calm on Wall Street. Equity still very close to all-time highs. Things in the Middle East, anything but calm so far this morning. Equity futures negative by 0.75% on the S&P. On the Russell, we're down by 1.5. In the commodity market, Brent and WTI. Brent crude briefly back in triple digits once again and very close this morning. Right now, 98.50 on Brent, higher by more than 7%. That's the cross-asset stuff. Let's get you some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. Some of the earnings we've gotten over the past few hours. Petco reporting well ahead of estimates. Shares up nearly 16% in the pre-market, showing that consumers, despite all the economic uncertainty, are still spending on their pets. It's also a turnaround story for Petco. After the spending post-pandemic, they started to lag. So this is them attempting a catch-up. On the other side of things, we had earnings from Dollar General, and this was a disappointment disappointment. I mean, not to a huge degree. The results were in line, but for them, that's not good enough. The shares surged 75% last year. They're up a good amount this year, too. This idea that consumers have been trading down. So sure, they're in line, but the expectation was that they'd beat in a big way. Finally, wrapping things up with Morgan Stanley. Late yesterday, that its BDC, North Haven, would be gating redemptions at 5% for its private credit fund. Again, feeding into these fears over the funds themselves, and private credit shares down 2.8% of Morgan Stanley in the pre-market trade, John.
Danny, thank you. Looking forward to the program. Danny Berger, Matt Miller, picking things up in about 15 minutes' time to guide you into the opening bell. Tracking the story as it develops in the Middle East. Bloomberg's Jemana Basechi joins us now out of Dubai for more. Jemana, welcome back to the program. We're all standing by here because we've had some indication from a semi-official news agency out of Iran that we might be getting a statement from the new supreme leader. What are you and the team looking for?
Yeah, that's right. So they suggested that a statement is imminent. It's coming out on a Telegram at any point. This, I will say, will be the first statement that's going to be delivered by this new supreme leader, the son of the former supreme leader, Mujtaba Khamenei. And what's interesting about this is people have been speculating about his whereabouts since February 28th, since that initial strike on the presidential compound took out his father alongside other key personnel as well. And there were some questions as to whether he was actually still alive. Interesting that they will be releasing a statement. Unclear whether he himself will be delivering the statement, a video statement, or whether it's a written statement. We'll have to wait and see in a couple of minutes when it is released. But the point here is it is very unlikely you're going to get anything but more of the same, i.e. more of defiance and pledges to retaliate. This is an individual who is quite literally cut off the same cloth as his father. He's just as hardliner, if not more hardliner. He has the strong support of the clerical community. He's been supported by the Revolutionary Guard and was placed there because of that support. There's little doubt that his elevation is also going to raise the influence of the Iranian military command structure. And it isn't really going to lead to any significant changes in the multiple layers of the power structure that exist in Iran as well. He himself was placed under U.S. sanctions in 2019. He's also been criticized or accused of interfering in elections and of being involved in those brutal security crackdowns that we've seen versus Iranian protesters. So in no respects is this a Delcy Rodriguez situation. And I don't think anyone really anticipates the statement that is due imminently to show anything but defiance. And indeed, if you look at the language that has come through from some of those IRGC commanders, from the military command, from Ali Larijani, the individual who's leading the National Supreme Council, what they have suggested is that this war is going to go on, and they are fully intent on pursuing this war of attrition because they sense and they see that the economic costs are mounting, and they're trying to push the U.S. as much as they can on the pressure points.
Jemana, appreciate your leadership this morning. When we get the statement, of course, we'll bring the headlines to you. Jemana Basechi there of Bloomberg, she'll bring the headlines to us, I'm sure, as well. This headline cross, just as we're having this conversation, just tracking the move in energy and then how it spills out, feeds into the rest of the world. This from Air France KLM, according to AFP. Raising long-haul ticket prices due to the price of oil, not the first, probably won't be the last.
We saw it earlier this week with all the Asian airlines, and now you're seeing some of the Europeans one. We heard from Willie Walsh, the head of the International Air Transport Agency, talking about today. At a conference, you are going to see airline ticket prices move 8 to 9% higher. We are 13 days in. If prices remain elevated, it's going to be incredibly challenging for the jet fuel market.
Tyler Kendall standing by down in Washington, D.C. Tyler, welcome back to the programme. You're seeing the real-world impact. You've seen an early response from the administration and other members of the IEA. What's next is always the question people will ask in markets. What's the other options?
Well, John, at this point, we know that the Trump administration is mulling a few potential options when it comes to curbing these higher prices, as just this week we saw retail gasoline hit its highest level under either of the Trump administrations. The thing is, there are real questions about implementation, timeline, and what will actually curb costs for American consumers. Bloomberg News had reported yesterday that President Trump is mulling even invoking the Defense Production Act emergency powers that could help spur offshore production off the coast of California to help boost some domestic supplies. The president has also floated, according to our reporting, the potential of asking Congress for a federal gas tax holiday. We've also know that he's considering waiving what's known as the Jones Act, which puts restrictions on goods being transported within the U.S. so that they have to be on U.S. vessels. So there's a few different options here. President Trump also previously floating earlier this week that we could see some more waivers when it comes to oil-related sanctions, though didn't really specify beyond that he spoke with Russian President Vladimir Putin. But, John, as you well know, this is just heightening the political pressure on the president as we head into the midterm campaign season.
Tyler Kendall, thank you. Tyler, down in Washington, D.C. In the commodity market at the moment, just off the highs, 98.13 on Brent, WTI 92.90 off the highs for the session, the high of the session overnight, north of $100 a barrel once again on Brent crude. In the bond market, yields slightly lower on a 10-year maturity, 4.22. Oksana Aronov of JPMorgan Asset Management writing, bonds have proven challenged in hedging equity volatility, which should be a wake-up call to investors, continuing to believe that a cutting cycle from the Fed will bring lower long-term rates. Oksana joins us now for more. Oksana, good morning.
Good morning.
Translate this shock in energy into the bond market for us. What do you see and why?
We've said for a long time that long rates do not respond to what the Fed is doing at the front end. Long rates are moving on the fiscal backdrop, inflation, and technicals, meaning the amount of issuance that we have in treasuries now. And this just absolutely underscored it because, of course, an oil shock creates an impetus for potentially more inflation. And so you're seeing bond yields move up precisely at a time when investors need that hedge in their portfolios. And so I think this idea, this fixation on the Fed cutting is neither getting us the affordability that we're looking for, nor is it providing that, long end rally that people are relying for on to diversify their risk elsewhere in their portfolios.
So 10-year bond yields at the moment still quite range-bound for the year. The low about 3.90, the high around 4.30. Are you expecting to break out of this range, given what's developing in commodities?
If we see a consistent shift up in oil, and by the way, oil is not the only commodity, right? But you also have, obviously, other commodities moving up. You also have things like fertilizer moving up, which impacts food costs as well. And so if we see kind of a continuous impetus higher for inflation, then yeah, absolutely, you can see a sustained move up in long rates, again, against the backdrop also of a fiscal backdrop and a widening deficit, that it's just not resolving itself.
Is that how you explain the idea that people are trying to price in a fiscal deficit? Is that how you explain the mismatch between long-term inflation expectations as expressed by break-even rates, which have remained quite low, just above 2%, versus 10-year yields, which have been rising pretty steadily in tandem with oil prices?
So inflation expectations are very much a product of what investors kind of see now. And so the moment they start to see prices are moving up further, or it feels that way, right, we're going to see that reflected in inflation expectations. And that, by the way, is the worst, kind of the Fed's worst nightmare, because they can't really solve for that, where it's very difficult. It's not a CPI measure that is sort of objective. So I think they tend to have more volatility to them. They tend to be more sticky once they do rise. And so avoiding that scenario is a best case scenario for the Fed, which already is struggling to get inflation kind of in its, consistently CPI or PCE, right? It's consistently significantly above their target.
So based on what you're looking at, which is potentially rising long-end yields, and they already have risen a significant amount, with a backdrop of already some stress coming through in the credit markets, how much more risk needs to be priced in to particularly lower-rated credit, given potential contagion coming from private credit, given the fact that there could be some pressure on the more stressed balance sheets?
Yeah, so the question here and the key word here is opacity, right? There's a lot of opaqueness with respect to private credit, particularly. We see what's happening with BDCs. We see what's happening with retail-driven private credit exposure. And there are lots of questions around valuations, around liquidity. Will I be able to get my money back? Is this thing worth what it actually was? And I want to kind of bring in maybe a bit of a different lens because there are a lot of questions around how systemic is this. And of course, we never know ahead of time because if we did, we'd put guardrails against it. So we don't ever know what's systemic ahead of time. But one kind of avenue is potentially the insurers that have increasingly more exposure to that universe as well. You know, insurers own something like $2 trillion of private credit, which comprises 18% of their overall bond holdings. And that's not just private. It's a combination of, you know, lending to middle market, CLOs, BDCs. So BDCs are actually a very small part of their portfolios. But alternative asset manager-owned insurers own a significantly larger component of these things, and BDCs included. So you do have just more risk-taking on the part of an industry that historically has invested in investment-grade credit, right? And now is taking more and more risk in high yield and in illiquid, you know, unrated or lower-rated credit. So is that potentially a channel for a systemic, you know, disruption of some sort? But we'll leave that aside for now. We definitely believe that this credit cycle, which is the longest one we've had really on record, we haven't had a credit cycle in a decade at this point. We do think that it is very ripe for a turnover, that it's coming to an end, and that you are going to see meaningful repricing, not just in these structures that, you know, are BDCs or private loans, but it is going to spill over into other forms of credit in the broader markets.
We heard something similar from Apollo as well. Oksana Aronov there of JPMorgan Asset Management on the channel for potential contagion. Getting visibility on these things is really difficult too, because one of the firms we were talking about overnight, their move to limit redemptions was essentially a fund of funds. So tracking where the money all is and where the money's being pulled from is getting harder to do.
Which is part of the problem. And at what point do people just start demanding transparency in order to have confidence to invest? I thought it was notable that Apollo came out, that we heard, of course, from John Zito saying we're planning to release pricing every single day because guess what? We're going to show we're not a bad actor and we're going to show what you should be doing. So, you know, watch for more of the same.
Putting some pressure on the competition in some ways, I'm sure.
I have no doubt.
Yeah. Brent crude this morning, 98, higher by 6.6%. Coming up tomorrow, Jordan Rochester of Mizuho, the Port of LA Director Gene Soroka, Jill Carey-Hall of Bank of America, and the Flexport CEO, Ryan Pedersen. Looking forward to getting to the weekend, as I'm sure you all are too. From New York City this morning, good morning to you all. This was Bloomberg Surveillance.